All right, so there's the recording. So let's start presenting as well. Day 2. All right. So welcome everyone to the second day of the bootcamp, and I hope you enjoyed yesterday's bootcamp. It was a lot of gems, especially on the hard time frames. So the vet taught you some great stuff that you can actually utilize to do your hard time frame analysis, to determine your levels and everything. And in today's bootcamp, we're actually going to focus on what to do when the price gets into those levels. So of course you can enter aggressively from those levels right there, but you're gonna see all of the entry patterns that I personally utilize, and I'm gonna actually dive a little bit deeper into the whys of price. I'm gonna show you a couple of concepts that you can start looking at, and you're gonna spot as well that I want you to focus on that word. It's observe. So you're gonna see me speak about observation and observe a lot of the times, and also I also highlight it in the most of the on the slides, because the thing that I'm going to share with you right now, like all the things I have, also what the vet shared with you yesterday, those concepts were gathered with months, weeks of experience and just observing, just monitoring, paper trading, live trading, demo trading, whatever it is, it takes time. So if you expect like to jump on a bootcamp today or yesterday and just like get it from the first time, it's not gonna happen. So at the end also of the bootcamp, I'm gonna give you some actionable steps on what to do from now on. And I have given this assignment to quite a lot of members. So I hope some of you have actually done it. For example, to backtest 50 trades, then we jump, review, but yeah, let's not get ahead. Let's actually get started, because I'm very excited about the end, because that's when I'm gonna actually give you the steps. So you can actually go ahead, start from today or tomorrow, and it's going to be like a little journey for you. Okay, so let's get started, because we have a lot to cover. So I'm going to dive a little bit deeper into order blocks. How do they form and what is their agenda? Because I really want all of us to actually understand the why of price, because it's really simple, like market structure, cool, higher highs and higher lows. But then why do those higher lows and higher highs form? Okay, it's because of supply and demand, it's because of order blocks. But in this occasion right now, we're going to jump deeper into order blocks and what exactly happens within those things. Okay, and why do they happen and how to refine them on the lower time frames and all of that. So let me show you the first thing you right here. So this is the agenda, the order block agenda. So basically what it does. Okay, so that process of the OB creation consists of a range, initiation, mitigation of the range, and then a potential continuation. Okay, and we're going to see a lot of times that in between the range and initiation, we have a manipulation. But I did not include this because it's going to get too much. Okay, and basically the manipulation is part of the range, as you're going to be seeing. And of course, range, initiation, mitigation, they have many minor details for each of those phases. And in this bootcamp, we're going to examine every single one of them. Okay. So basically what we do is we trade after the initiation. So again, I'm going to explain what is initiation. This is basically when the market actually makes a move up or down. While we're in a range, we do not know what is yet to happen. Okay. So basically the market first starts with a range, right? And then where is it going to go? We don't know. So we cannot just place a sell order inside the range. What we do is we wait for the market to initiate outside. And this is when we start trading and start following the flow. Because basically the initiation outside of that range is the thing that shows us, okay, the money is going there. We're going short. And then basically the range creates a potential mitigation area, which we're going to have a look at a little bit later. But in this slide, I'm not sure why the quality, maybe because I made it full screen, got a little bit worse. We have the range right here. The market starts to push down. Then we have the initiation. During the initiation phase, when the market is actually pushing down, you could have a couple of opportunities to trade on the move down. And then potentially the market is going to reach a level at the bottom and it's going to start pulling back. And basically this is your mitigation phase. Okay. And you can trade this, but it's classified as a counter trend trade. And we're also going to examine how to do that as well. So those are the three things that we're going to be focusing on today. And of course, how to trade them. Okay, so range, initiation, mitigation. So let's see. So basically, let's start with the range. So there are a lot of notes, but I typed in as much notes as possible so that you can review later, copy, do it in your own words. I just want to lay out all the information because I really wanted to say a lot, and I just typed it in text so that I make sure that I cover everything. Okay. So a range, as we're going to see in a bit, can form in many different ways. Of course, what is important is the psychology behind it and how it forms. Okay, because we can see that there are mainly three types of ranges that we're going to identify, but it's really important for you to actually zoom in a little bit on that range and see what is happening inside. And we're usually going to do this by utilizing the lower time frames. Okay, so basically what we'd like to see is a range, consolidated price action, or as well choppy price. And this is when actually the institutions are stacking exchanging orders. This is when they are at fair value and they're kind of buying, selling, agreeing on a specific direction or price. And then basically after they're done with that, after they have also manipulated us, the retail traders, then the initiation begins. And it usually begins within the range. And this is where we're going to identify the buy to sell or the sell to buy. Okay, so this is just the theory right now. We're going to jump into a lot of examples. And basically that buy to sell and sell to buy, this is their final act before launching the orders. And then basically after we break out of the range, we're having the initiation phase, which we can as well trade by using order flow and mitigations, which we're going to see later as well. So again, you can see the observation is starting. So what I want you to observe is how the range forms. Learn to spot the ranges. What I did is I focused 2 weeks on just spotting ranges. And what I found out is that the market always reacts from a range, because the range is basically, this is how the market moves. It creates a range, it goes away from a range, and then comes back into the range. That's it. Because within the range, this is where, again, the orders are stacked, remember, and when they initiate outside, this is, they entered from the range. So basically, if they want to enter again, they're going to drive the market where they entered initially into the range and launch the orders again. So this is why the OBs and why the supply and demand works. This is the psychology behind. They cook their orders right there. They initiate the price, but of course they're going to return a little bit to pump in a little bit more and then to continue higher. And this is also how market structure forms. Higher high, then we pull back for a higher low. But why does the higher low form? Well, because they want to pull back into the range to launch more orders. And of course, on the move down right here, a lot of people are also tricked. Okay, so basically that move to the downside, which is the mitigation phase, we can also trade, but we have to be aware of the overall trend. Okay. And of course, what I said on the webinars, that within imbalance as well, there is always a range on a different time frame, possibly the lower one. So if you see an imbalance on the hourly, and if you jump like on the 5 minute, you're going to see something within that imbalance. It's not just empty space. There is always a sell to buy or buy to sell within it. So what I challenge you to do also is to just go and see if that is the case, because I've seen it many times. And basically how are we going to call this is just RIM, which is range initiation mitigation. And this is your main thing that you're going to be spotting from now on, because it just works amazing. Okay. And then as well, you have to observe how the initiation starts. Is it strong, long-bodied move or a slow, wicky move that does not cause a break of structure? Okay. So first you're going to start from observing ranges. How do they form? Then you're going to start observing how the market leaves those ranges and which is actually the best price delivery outside of the range. Because you're going to see that sometimes the market just explodes with long-bodied candles, very sharp move, leaving imbalance as well, what David explained yesterday. But sometimes it's like very sloppy, wicky, it's not really strong, and most importantly, it doesn't break structure. Okay. So it's really easy for us to tell you right now, well, okay, cool. For an OB, we need a sharp move and a break of structure. Okay. But if you haven't seen this yourself, and if you haven't compared OBs that do not break structure or OBs that do not move impulsively, then you do not have it on the back of your minds, what works and what doesn't. So again, spend the time to observe what works best. And I'm going to give you the tools to do that as well. And the refining thing that we use of an OB, it's basically taking that higher time frame OB range into the lower time frame. And then what we do is we just find the precise place of the initiation, which, as I said earlier, is the buy to sell or sell to buy. So there is your first exercise. When you open a chart, search for ranges that had a strong initiation outside of them and also caused the break of structure. And then see how the market returned back to them and reacted amazingly. Okay. And also a very good exercise that you're later going to receive is just dropping a higher time frame OB and just going on the lower time frame to find the buy to sell. But I'm first going to explain what those are, and then we're going to jump onto my charts as well. So that was a little introduction. Hope you're not really confused so far, because it's just theory. So right now we're going to jump onto some examples. Let me hide that stuff right there. I don't see the slides. Okay, so there are three main different types of ranges that I have identified. So basically, one of those is when you have a prolonged consolidation. Basically, you have a consolidation right there. Then always you're going to have some sort of a sharp move up or down, respectively, before the initiation lower. Okay. And there are, of course, those little details that I cannot really tell you, because you have to find them on the charts yourself. Sometimes, for example, when you have the range, you have a sharp move into the highs, then the market pushes lower, leaves a little high like this, and then initiates lower. Okay. And this is when you guys get confused sometimes, and you're like, because this could be an OB, might be a little bit lower. And you say, okay, do I trade from this, or do I trade from the actual manipulation, which is the actual buy to sell? And basically this one is liquidity to be taken in order to tap the 50% of the range, as we're going to see a little bit later. But this is basically the normal range, manipulation, initiation lower, and then we return back to retest. The second one is usually a little bit quicker. You just kind of move down, move up, higher low, a big high, and then just a move down. And as you can see, in this case, we do not have this little guy. So what usually happens is the market is going to stack liquidity just before it taps into the 50%, and then it leaves. While this one tends to be more aggressive. This is going to be the aggressive buy to sell entry that I'm going to teach you as well, and then just move away. And the final one that happens also a lot, and it's not very clear on the charts, is you have an overall kind of uptrend that is not really clear. It's still kind of sloppy and choppy price. You have like an uptrend, push, pullback, then you have a very sharp move into the highs, and then just a big drop to the downside. And this is basically your range, which is a little uptrend, the manipulation, and the initiation lower. And then basically you can trade that move to the downside if you have the opportunities. Then there is your mitigation into the range and your continuation. So those are basically the three types of ranges that you're going to see. And on the charts, they're going to look completely different. So this is why I always tell you guys, go practice and spot those things so that they will become a little bit clearer for you. Okay. And of course, always spot once the range is left, once the initiation is done, what is happening within it, which we're going to examine a little bit later. Okay. Because usually it's going to build up some liquidity right here, or it's going to have liquidity right here, or it's going to have liquidity right there. Because liquidity is what is used to fuel a move, which is what the vet told you as well. And you can, of course, if this is on the 1 minute, it's the same thing that we saw yesterday. You can have an OB, you can have an imbalance, and you can have a previous high. It's basically the same stuff, but refined in the lower time frames, which is simply the same. Okay. So a lot of text again, but this is the sell to buy and buy to sell concept. Okay. It's really simple. It's just a sell to buy. It's a big sell-off before a big buy, or a big buy before a big sell-off. It's that simple. The only hard thing is actually spotting it. And what is the psychology behind? Well, the institutions that are Divina and Walter, as you know, those guys move the markets. They love to trick people into buying and selling before they actually launch their orders. So basically, that move away from the range always lacks volume. So if we actually go and check, there is a 2 volume profile, you're going to see that the big volume is actually collected within the range, and then the buy to sell actually does not have enough volume. So if I just annotate this very quickly, is if you have a range like this, and then you have a sharp move into the highs, the volume is right here. It's going to be in the middle. And this move into the highs is just fake. It does not have any orders. And then you have the move down. So basically this is your buy to sell. This big buy before the big sell-off that broke structure. And basically this is the creation of your range. This is your POI, or your order block. Okay. And of course, then why do we return back to those buy to sells? Is because they are at a loss. Because in order for them to buy the market and then sell, then that buy is in drawdown. Okay, so what they do is they just come back to mitigate those floating losses at break even. They still trick people on the way. And then after they actually mitigate those losses, they launch new orders, and then you see another expansion. So basically, this is the full delivery of the range, the manipulation, initiation lower, mitigation to mitigate their losses. And then this is usually when you have the big move. Okay. So it's really important because I had a lot of questions like what is buy to sell, what is OB, what is supply and demand? It's basically the same. Everything is the same. It's just a buy to sell or a sell to buy is an OB on a lower time frame, or just a series of candles on a lower time frame that form, for example, a 15-minute OB. Okay, so if you spot a move down on the 1 minute, like a big move down on the 1 minute, and then you go on the 15-minute, you're just gonna see one bearish candle, which is basically your OB. And I have said this numerous times as well. Just drop your full hourly OB or drop your 15-minute OB and then just jump on the 3 or on the 1 minute. And what you're gonna see is a series of big candles and then a big initiation higher. So that is the thought process, okay? And what is the benefit of that? Is it the 1 and the 3 minutes? Basically, if we refine that OB on the lower time frame, it gives us insights exactly where that move began. And that this is within the range. So within the range, as we're going to see in the examples, we're going to see that sell to buy. And this is where we're actually going to trade from. And this is how you get that precision, okay? And as I said, again, it's a lot of details and everything is in text. We're going to have more examples. Just type those notes down as little points. And then we're going to see on the charts how all of those things are everywhere, because that is information I've gathered from with a long time. So it could be overwhelming right now, but everything has to be laid out. And then we just take it step by step with mini lessons as well. So buy to sells and sell to buys usually take some sort of liquidity or mitigate something on the left. And that signifies order flow. And we're going to see this basically when we have the continuation buy to sells and sell to buys. That big buy before a sell-off is usually going to tap into something on the left. And this is how they also avoid further losses, because yeah, if I just make a quick drawing, I might be going ahead too much. Is if you have a range, a buy to sell, then basically they're going to pull back, create another range, a buy to sell. And basically what they do is they mitigate their losses from here. Then they do another buy to sell, and then they're going to pull back again right there to mitigate another loss. So basically right here, we took liquidity, we mitigated the previous buy to sell, we launched new orders, but we're still in drawdown from the new buy to sell. And so what the market is going to do is going to pull back again, maybe a new buy to sell. And this is basically why market structure forms. So it's really important to see also what is on the left. Do we mitigate something and do we take liquidity? And of course, how do we trade this is by taking 25 and 50% of that range, and we trade it from there. So I think right now I'm going to jump on the charts a little bit. Yes, before we jump on the initiation phase, maybe we have to jump on the charts a little bit and just to try to spot what exactly those buy to sells are. And as I told you, like what you do is you just take an OB, whatever it is. Currently, a very fresh example is this one, which is a kind of an OB. What it did, it broke structure into the highs, and we potentially expect the market to pull back right there. So what you then do is you drop to a lower time frame. It doesn't matter which, and just go and examine what is happening right there. Well, this one is a little bit extreme example because yeah, it's a little bit too big. But what we have again is your range, a manipulation lower, and then the market, as you can see, it's going to initiate higher. And basically this thing right here, this range created your OB that is on the full hourly. Okay. And then what we're going to cover exactly right now is the initiation phase. And basically there is your initiation. When the market starts to initiate, you can have numerous opportunities as well. But what we cared about is later the market returning back to this level and actually continuing. So there is a price delivery, the range, there is your range, there is your manipulation. What it did, it possibly mitigated something on the left, and then we very sharply impulse into the highs. And let's maybe try to find another one. It doesn't matter where. Let's maybe do, how did this one play out right here? Because that one looks pretty strong as well. Then what you do is you drop like this. You maybe drop to the 3 or to the 5 minute. And what you have right there is, again, you see it's a big range. Okay, so what you have is an overall range. It even starts on the left, range, choppy price, a big buy, took liquidity on the left, and then we're still in the range. But this is basically this is the manipulation. Okay, this is how I marked it in the previous slide. Where are the ranges? Where are my ranges? There they are. So within the range, we have that red zone before the initiation. And usually within, you can see that there is going to be some little liquidity. So there is a good example of this. There is our big buy. I also have a template for that manipulation. There is the big buy. Then we still consolidate, generate liquidity, another sell, another consolidation, and another buy to sell. So basically right here, what you can see is we have a range, manipulation, and then the initiation lower, you can see. So what we can do is we can drop to the 1 minute. So there it is. The range first manipulated lower, but then there is the buy, and then there is the sell-off. So basically what you're going to do right now is you're going to take it like this from the low to the high and just do EQ. So this is your area where potentially we would expect to short the market, because there is your range manipulation. Then yes, we kind of consolidated again, but then we had another range manipulation, initiation lower. And then if the market returns back to that level, which I'm not sure if it did, I think not really. Where is it? Yeah. So we're going to see right now, maybe in the future, how this one is going to play out. Okay. And yeah, I can give you a lot of examples of this one, but this is an exercise for you to do. Like just go on the hourly time frame or on the 4-hourly time frame, and then just spot how those OBs work and how do they form. Let me quickly check the chat. We would like to.
I'll tell you, bro, when we have some questions.
Okay, cool. Yeah. I'm just put on the chart, the chat on the right here. So yeah, maybe let's have one more example. Just on the hourly, it looks good. This one, sale candle before a big buy, also broke structure right here. So this is potentially an hourly OB. Let's try it like this. And then what you do is we go like this, and then we jump on the lower time frame. So let's see. So again, as I keep telling you, it's going to look in many different ways. But what we have, let's see, is, yeah, our range is a little bit on the left right there. So there is the range, there is the manipulation of the range, and there is the initiation higher. Okay, so what we have right here, this could possibly be like, this is not the perfect example, because this could possibly be this liquidity that I spoke about right here. So basically there is your whole manipulation, there is your big sell to buy, and there is that little liquidity. So if we get it like this, you can see that just above the 50%, we have liquidity, which is basically this example right there. And let's maybe see how it played out, because I know that this one tapped. We did not get a follow through in it, but let's just see if something happened. You can see that we basically tap inside this whole area and we had a reaction. You see reaction. The market really tried to pull away. But what happens is that potentially we went to mitigate. What is this? Another buy to sell on the left. This one is during the initiation phase, because this is our big range. And then during the initiation, you're also going to have a lot of buy to sells. Basically, there it is. We have, again, like a sloppy price action, sell off, big buy. That also took some little liquidity right there. And then we just initiated lower. And if I further refine it on the 1 minute, I can see this little candle right there. It's also buy to sell. So if you drop to the 1 minute, there it is. And you can see again, what we have on the 1 minute is a range manipulation, then was sell, a big buy, and then we just actually plummeted down. So if you really want to be precise, this is your level right there. And if we actually, let me see, somebody's tuning in. If we actually go to see what happened right now, there it is. So basically absolute precision from the 1 minute, there it is where it reacted actually. Okay. So this is how the ranges form. And again, what I also did is just drop to the 1 minute, for example. And yeah, you usually would like to do it in the active sessions. There is a really good example right there as well. You can find them everywhere. There is your range, manipulation of the range, initiation higher. Where is your sell to buy? It's this one. Okay, there it is. You mark it like this. You take it from the high to the low, and then we can put this eventually right now. If we jump on the higher time frame, let's just try it out. Maybe on the 15 minute, this is going to be an OB. Let's see. Let me remove the drawing. There it is. You basically have a sell candle, maybe the 30 minute. Yeah, there is a 30-minute indecision before the market left up. And
can you explain what is the difference between a flip and a structure break? Someone asked.
Simon, this is to come in a bit. So I'm going to explain this. Don't worry. But okay, so guys, does that make sense? Am I making it too complicated? So basically, we just had a look at how the ranges were forming. And this is basically examining higher time frame OBs on the lower time frame and just looking at the psychology behind. And you can see, for example, how you can drop a 4-hourly OB or an hourly OB and then just drop to a lower time frame, spot the buy to sell where the actual manipulation happened, and then potentially trade from it. So does it make sense, guys? Do I have the pulls on this thingy. Everything clear. Is everything clear so far? Let me try to put that on. Because sometimes I feel like I speak too fast and too much. Okay, yes, this is already coming. Okay, good. I am happy that it's clear, guys. If something is not clear, then just interrupt me. Okay, so hopefully that's clear. We're going to have a look at more chart examples as well later, because I've put some in the slides, but that is the range phase. So basically the range is when the OB is forming, and the delivery is a range, manipulation, push higher, pull back, and a continuation. This is basically it. And this thing is your range. This is your OB, but then within the range, you're going to have the sell to buy, always. Not always, sometimes it's not that clear, but usually you're going to have that manipulation, because again, as I told you, Divino and Walter love to trick people into selling. So this is basically your sell to buy. Okay. And we're going to have a look at more examples later. So let's carry on.
I have a question, or
yes.
just something to make it clear for myself. So basically what you're explaining now is the different type of initiation ranges to find the more refined entry inside the OBs.
Yeah.
Okay.
No, it's not really the initiation range, it's just the range. It's just explaining what is happening, like the OB agenda, because we tend to say, okay, this is an OB, but why is it an OB?
Yeah.
Then drop to lower time frame and actually see what happened inside. So this is what I explained. And basically, because you might drop to the 1 minute right now and get confused, and I give you those kind of ranges to actually try to spot. Like sometimes you're going to have a big range, then a big manipulation, as we saw in one of the examples. Then the market is still going to stay in the range and then initiate. But basically, there is your manipulation. Sometimes it's going to be really sharp. Sometimes it's just going to do this, like a downtrend, boom, like, and then break structures. And then basically this later becomes your sell to buy. Or sometimes it's going to be like carrying to the upside, carrying, then you're going to have a big buy and then a big sell off.
Okay.
Yeah, so those are the 3 types that you're going to see. And again, we can put also assignments to actually spot those on the charts.
Yeah, all right.
Good.
So only Pauline also is not
Okay,
having
let me mute. Okay, let's carry on. We got to the initiation phase. So let's see. So right now we're going to have a look in more details onto all those different phases. So the ini phase, how we can call it in short, the initiation phase can look in numerous ways. Okay, sometimes it's just going to be a straight push without a stop, and or sometimes it's going to have like a series of mitigations. Okay, the initiation phase can be tradable, but as I said, not always. Like sometimes we're just going to have a move up and we cannot trade this, but most of the times we're going to create new ranges and new mitigations, which we can basically trade until we reach something on the left, and then the market is gonna start giving the pullback and initiate the mitigation phase. Okay, so the initiation will create the structure break that we need for type 1 or type 2 entry. So this is basically when you have your structure break, when you have that strong push up. Okay, so trading from the range and trying to catch that initiation, so basically seeing the consolidation and then trying to see, okay, the market is going to go up right now, is not always a great idea. Because yeah, if it's in your plan, if you spot a range and you're like, okay, cool, the market is right now cooking, as you know, and it's going to initiate higher, then you can maybe take a long just by following the order flow on the 1 minute within the range. Because you can also use the 1 minute, guys, to for example, if you're in a range, within the range, you're still going to have little ranges, mitigations, little ranges, mitigations. And then after a mitigation or manipulation, you're going to have a big move up. So sometimes you can catch it before the initiation, but it's not advisable to do. Okay. And then basically, what is really important to note is that the initiation phase is going to become liquidity later to make the mitigation easier later on. Okay. So basically what we have right there is, again, 3 examples. The first example is just a straight move into the highs with very little stops that are not tradable. Second example, we can have a nice push, but then a big mistake that a lot of us have done is to wait for that push and then to wait for an immediate pullback into the range and continuation. Well, the market doesn't always do this. And what it does, it just keeps climbing into the highs into its initiation phase. What we have is a new range, manipulation, initiation, higher, pullback. There is your long. Then a push up, and then the market can just continue to carry on. Sometimes we're going to have a range, the market initiates outside, then stops for a bit, and you're like, okay, cool, wow, liquidity. So right now I'm going to wait for the market to pull back lower and take a long. But what it does, it initiates higher outside of the range, pulls back, and then continues higher into the highs. So then this range, what it does, it becomes a higher time frame OB usually. I see questions, guys. You can interrupt me.
Yeah, just on this section, obviously at the start you've got your first breakout, but how do you know once you've got a new range? How do you know which trade to take after that? Do you always go for the most recent one?
Mm-hmm. Yeah, well, that's what you do. Yeah, and we're gonna see examples of that as well. Because again, Kyle, like I've done this tons of times. You have the higher time frame OB created on the range, then the market initiates higher, and then it just keeps trending up and up and up and up, and you're left waiting for this one to tap.
Yeah.
So this is why a little bit later, once we jump onto the entries, I'm gonna teach you the continuations. So basically, those are those continuations. You just follow it until the market reaches a higher time frame OB and starts to shift, and that's when you can potentially look to reverse. And this is when it's gonna come into the higher time frame OB, so you can take the original trade from there. But yeah, we're gonna have examples on that.
Cheers, man.
And then again, yeah, let's spot some on the charts. Then what you do, guys, for this exercise is you go onto your charts. And again, like let's take a very recent one. There is the OB right there created, high time frame demand, and there is your initiation outside. So if we drop right now to the 3-minute, what we're gonna see, there is a good example, Kyle. So let's say that, yeah, this one is a little bit, do we have a 50-minute OB right here? Let's say that you say, okay, cool, my 50-minute OB is this one. This is the manipulation, there is initiation, and then the market is, so look what the market does. It pulls away and it doesn't come. And for example, you could be, you could be right here and you say, okay, cool, I'm gonna wait for this. Then the market goes in here. Cool, I'm gonna wait for this. Then the market goes in here, I'm gonna wait for this. Wow, we just like created a sell, buy, pullback, push, pullback, mitigation right there, another mitigation right there. And then basically, yeah, we started changing a little bit, but you can see that after the creation of this higher time frame OB, the initiation phase took place for quite some time. And right now, actually, we can say the mitigation phase has occurred because we can see that the market is failing to break above and we're starting to pull back. So basically right now, potentially next week, we expect that mitigation phase and then to potentially have the continuation. Okay. And then again, you spot a new one. So what happens right there? Look at that. So very good example, just on the 50-minute. As I told you, those things happen on every time frame. We have a range, manipulated lower, manipulated higher, and then we initiated lower. Okay. So what you do is you're, okay, cool. There is my higher time frame OB right here. And then you just wait for the market to come inside. But sometimes if I drop to the 1-minute right now, there is a trade right here, right there, right there, right there, then right here. And then basically from here, we start the mitigation phase. And do we tap into that area? Well, we tap later, but again, you can see we just react from it and then we keep carrying on to the upside. Another one, maybe there is a nice sell to buy right here as well. But what the market does, I think this one is a good example, basically. There is your kind of a range, which is again, not really clear, but we have the sell and then we have the buy that also breaks structure, but it doesn't immediately pull back into this. Look what it does. It keeps creating demand. This is demand. This is demand right there. Maybe something right here. And it just keeps moving higher. And what you can do on the 1-minute is you can just trade those because it's brand new things. There you go. On the 1-minute, you have a range, manipulation, a break of structure. There is your long trade. Right here, you have a range, manipulation, slight accumulation, break of structure. Well, this one did not pull back. It's fine. And then you can see that you have numerous continuations. There is one potentially, yeah, within these little ranges right here. Then you jump into the highs and then it just continues. So the point of that initiation phase is that not always you're going to have an OB push pullback and then a continuation. Sometimes this phase takes too long, which is something that I want you to examine. But again, so after you're done with the ranges, identifying the ranges and the OBs, then you identify how do the initiation phases work. Like look at that, for example. That this was I think this price delivery right there is a good example of that trending buy to sell, because the market is basically push, pull back, push, pull back, push, pull back. Then we have a buy and then a sell off. Maybe it's going to be clear on the 15. Yeah, it's still a range, to be honest. Maybe on the 3. Yeah, there it is. Well, you can see it's an overall uptrend, but we can still say that it's an overall range. And then we have this buy, and then there is the sell-off. But what happens after the sell-off? Look at the initiation phase. So you can take a short from here. You can take a short from here if it pulled back. You can take a short from here if it pulled back, until actually the market reverses. Okay. So I really hope it makes sense and I'm not speaking too much. So this is basically our initiation phase, and it can look in those three different ways. And again, if you see the initiation, just keep following the flow until you're wrong, until the market reaches a hard time frame OB, which is where the mitigation phase actually starts. So again, the mitigation phase begins once the initiation is over, and this will be seen by a shift of structure. Of course, this is depending on the time frame. Does a shift in order flow in the lower time frame signify the start? Yes, that is correct. But again, the lower time frame is going to shift within the range. And then as the initiation starts, you're already going to have a shift of order flow. So then it's all about actually following it to the upside or to the downside. We're going to have examples of that a little bit later. But basically, during the move towards the range, the price will bounce off of levels that were formed. Yes, so this is really important to note, guys. We're going to have a look at examples of that. It's so if I take my tool right here, so this is usually, I should have maybe dropped a hard time frame OB like this, because the mitigation phase is going to start when the market taps into something on the left. Okay, so you're going to have the range right here. There is the range. There is the initiation. So we trade up, we mitigate, we mitigate, we trade up, we trade up. And then we tap into something on the left, a hard time frame OB. And this is when the initiation phase is going to end. And then what you're going to have is a market structure shift. So it can look again in different ways. There are the three types potentially that you can spot the mitigation start. You just have the market structure shift, like a push, pullback, failure to make a new high, a break of structure, and a retest. So this is when you can go counter trend towards the range. Okay, you can have a brand new price delivery of an OB. You can have a range, manipulation, break of structure, and then potentially you can continue trading that until it reaches the hard time frame OB, which is your range on the left. And there is the third actually, which is just an uptrend. Then all of a sudden you have a big buy, like a big climax right there of buyers. And then it like pulls away, consolidates a little bit, another buy, and then we just start sell off. So we're going to see this in many different ways. So this is why you have to jump on the charts and try to find it, which is what we're going to do as well after we cover the theory. Okay. And basically what is going to happen is what I also want you to pay attention to, those little reaction points, this reaction point, this reaction point, this one right there. Those are going to be ranges from the initiation phase. So where a lot of people, including us, go wrong is that we try to trade every single demand on the left. So let's say that there was a sell to buy right there during the initiation phase, and they were like, okay, cool, I'm going to take a long from here. But simply as I said in the earlier slide, where is it? The initiation phase becomes liquidity after the mitigation phase starts. So after we have the shift from the top, all of those levels on the left that were during the initiation phase are going to get taken there, and they're going to be used as liquidity. So the market can also form liquidity on the other side. So then basically what this becomes, this right there, this and this is basically old highs to be taken on the way up after we mitigate the original range on the left. So basically, again, the range, initiation into the highs, then the mitigation is your pullback, and then you have the continuation, which is basically your best trade. Okay. And as I have said here, you can, of course, trade the mitigation, but this is a counter trend trade. So you reach a hard time frame OB, you spot your shift of structure, and then you just start trading it on the other way around. And then you can also combine it with the 50% range. Okay, because sometimes the market is not going to come entirely into the range right here. It's maybe there is going to be something a little bit above that we can react from. So that is also pretty important. And you can take it with lower risk. This is what I do, because if I spot a retracement trade, which is basically in the mitigation phase, then I take it with lower risk. Okay. So hopefully that is clear. There are our three thingies: range, initiation, mitigation. And again, you can observe this one as well. Like if we jump on the charts, then what you should do is you should go, for example, let's say that this was a pretty clear example. There is our sell to buy. What the market does, it reaches a buy to sell on the left. There is. So this is just the 3-minute and it's just a random price, right? We haven't even looked on the hard time frames, but there is, you see how it starts even from here. Like we have a sell, buy, mitigated, cool. Push, there is our initiation, there is mitigation, continuation. But as this is created, we have a new range, manipulation, initiation. So then the market reaches this buy to sell that had also liquidity right there. You can see how we're starting to put all the pieces together. It mitigates 50% into it right here. And this is when we also break structure. So this is when the initiation phase is over. And what we do is we start the mitigation phase. And so as soon as the market taps into this level, we start looking for longs. But can we take shorts, as I said, during the mitigation phase? Well, yes, we can. Because basically what you then see is a new range, kind of a downtrend, manipulation, and a break of structure. So this is when the initiation phase has started. And what you can do is you can just follow it like this. But yeah, oh man, it's too much. But basically this thing, the range initiation mitigation thing, it's everywhere. And you have to be aware of the overall picture, because you can see, like we're having this play right here, which is a range initiation lower and mitigation. We have the thing coming from the downside as well, which is again a range initiation mitigation. And right now, after the market has completed this sequence, we launch a new one. Range, manipulation, initiation lower. There is our initiation phase, and there was our mitigation that basically happened into this little guy right there. So I hope you're not really confused right now, because again, it will take some time, but you can see that this is just the price delivery, how the market moves. And it just jumps, as the vet said yesterday, from premium to discount, from premium to discount. And again, you can see that we have a hard time frame delivery right here. There is a range, manipulation, initiation. So right now we can jump into the mitigation and then impulse higher. And in between this thing, we have so many others that we can trade. Okay, so guys, does it make sense? Do you see how like those things are literally everywhere? So I hope you're not confused. And yeah, this is just hard time frame, lower time frame analysis right now. So the hard time frame was easier, but this is when if you really want to zoom into the details and trade the lower time frames, you have to be aware of how those things are forming on the lower time frames as well, while still knowing where you are on the higher time frames. Okay, so hopefully that is clear. I think it's already getting a lot, so let's proceed because we have a lot to cover. And yeah, we definitely have a lot to cover. So I'm gonna slow down with the examples a little bit. So yeah, there is a very good example, a very good price delivery. You have the range. Sometimes you can trade just purely the initiation phase, because sometimes when the market does not initiate very strongly, so for example, we didn't make a range initiation and a big initiation down, it just pushed lower, pulled back, cool. This range right now is mitigated, and we have a new one, buy to sell. The market immediately pulls back, trade it. A new buy to sell, the market pulls back, and then you trade it. Okay, because then basically you just follow the mitigation and you only trade from what is left unmitigated. And this is also an exercise that you're going to be practicing. And there is the long scenario. This is another delivery that could happen, which is like you do not get a big impulse into the highs and then a pullback. You simply get it done immediately. You have the range manipulation, the market pushes away, immediately comes back to mitigate 50% of the sell to buy, and then it just keeps creating new ones and keeps going in an uptrend. So this is also a pattern to include into your trading plan. So all of those pictures that I share right now, you should redo them for yourself or just screenshot them and then just go on the charts to practice them. I'm really pissed why the quality has gotten worse like this. But there is a little textbook example of potential range initiation and mitigation that combines absolutely everything that I said so far. So basically you have the market moving up. That range can happen in the middle of a move as well. But basically you have a push, the market slows down, there is your sell that also mitigates something on the left, takes liquidity, and we have a big initiation higher. During the initiation, we can trade it, but then the market reaches something on the left and starts to shift. And then basically we have a buy to sell right there. This is when the mitigation phase starts. And then yes, we usually are going to have some sort of liquidity. The market drops into the range, into the sell to buy, shifts structure. And this is basically the flip. This is the technique that I'm going to teach you a bit later. So this is your aggressive sell to buy entry. You just enter from the unmitigated sell to buy, but then you basically have a break of structure. But you can see that there is another sequence going from the left. We have a buy, we have the range initiation, the market comes to mitigate right there. But this is just a reaction point then for the market to pull back to tap you into the original entry, which is going with the higher time frame. And then this is a break of structure. You have a new sell to buy, we pull back again, a new sell to buy, and we just continue going up. And this is basically following the mitigations. So this is a textbook scenario of following buy to sell, and sell to buy, plus the concept of RIM. Okay, and I think I have a chart example on this one. Okay, and there is also another big delivery right here. So this happens all the time, and this is when a lot of us get confused with the higher time frames as well. So basically, you have like a 4 hourly OB right here on the left, and then we have a range, manipulation, initiation lower. And what you can see is that the 50% is not mitigated. So again, as I told you in one of the examples, we're always going to have something little like this right here, which is going to facilitate this because there is going to be liquidity on the left. So it's going to take it and just dump. Okay. And then what you also see sometimes is, okay, cool, I'm waiting for this one, but then the market breaks structure lower, makes a new buy to sell, but you're like, no, I'm waiting for this one. But then it's going to mitigate this. It's going to continue lower. And then basically this is your initiation phase. And you can see how it looks like. You have a range, initiation lower, pulls back, sell right here. Another buy to sell, pulls back, another short trade, pushes lower. But then you have to be aware, how can I remove this? Yeah. So basically then we tap into something on the left, as I told you, when the mitigation phase is going to start and when the initiation is going to end. Okay, so we have, for example, range, a sell into a 4 hourly OB. Then we have a push higher. It's going to react from the last supply, but then it's just going to keep carrying on. And this is when your mitigation phase starts all the way into this higher time frame OB. And so, for example, if this higher time frame OB holds, then this low is going to get taken because it's going to become a weak low, which we're going to see just in a bit. So there is a hard time frame example of that whole phase right there. So we put all the things together and you can see that this is just how it moves. But within that, it's like inception. You have those patterns everywhere. Range, initiation, mitigation. And you have the range, manipulation, initiation, low, and then you just start jumping lower. Okay, and you have to be aware always which is the higher time frame delivery, as we have right now on EU. Okay, there is just a chart example right there. So basically, we have the range. There is the manipulation. There is the initiation. This is a pretty sharp one. So we do not have a lot of opportunities on the way up. We just slow down a little bit, which basically becomes liquidity later. Then we break structure. There is the shift. This is where the market breaks structure lower. So if we potentially maybe had a pullback right there towards this level, we can take a short, but then the market goes all the way down into the sell to buy, reacts from it. And then you can also see right here, you can catch some lower time frame entries. But there is your range, manipulation, initiation higher, mitigation, and a continuation higher. Okay, so this is just a chart example. And yeah, a little slide right there is that not always it's going to play out textbook. Sometimes we're going to have a big battle between supply and demand because let's say, for example, that this is your OB. You have, again, a range, manipulation higher, initiation higher. It continues to go up, but then it taps into something on the left. It fails to break higher. And then from here, we start a new range. So there is a range, manipulation, and then it starts breaking lower. Okay. And this could also be classified as a flip or a break. It taps into this level. So from here, we would usually expect the market to go higher. But what happens is that the market comes to mitigate right here and it just shifts. And then it basically breaks lower. This is also an example that the vet showed you yesterday, which is like with the expansions. First you start, you manipulate higher, then you have like a big short, and then you have a big long, something like this. So this is what you're gonna see happen on the lower timeframes. I know it's a bit complex, but if you know what's happening on the higher ones, then you can see what happens on the lower ones. So this, for example, could be your Asian range. There is a manipulation, you get it long, but then it fails to break higher. It goes lower to maybe mitigate a projection block or something on the left. And then you can see basically the flip happening. And then the higher time frame prevails, and we're going to have this high being taken.
And question, please.
Yeah.
Sorry. What's confusing to me often is we do our higher time frame analysis, and then we trade the 1 minute. And basically every time there's a structure break or a flip on the 1 minute, we trade it, and then afterwards we realize that on the 3 minute or the 5 minute or the 15 minute, it wasn't really a structure break, and so we become hypnotized on the 1 minute and start over trading because of this. Any advice to counter that?
Well, yeah, of course. Just focus on yesterday's bootcamp. It's again all hard time frames. So, but my biggest advice on this one is to just spot your hard time frames. So just know what is the trend on the 4 hourly and just keep that in mind always. Currently, we're long. So we want to see right here, and whatever happens inside right there, then yes, you can take a short until the 50%, but as soon as it taps 50%, then you're longs. Because then yes, if we drop to the 1 minute right now, it's a complete mess right there. But again, if you know where you are on the hard time frames, then you're just gonna know how to trade. My other tip is, John, to focus on as I'm gonna tell you later, is to focus on only 4 hourly OBs and 50-minute OBs. So for example, you do not take a trade in the middle somewhere. Where you want to take a trade from is from a very sharp, a very strong 50-minute OB that broke structure to the downside. For example, you're not going to trade this one right there, this price action. You're going to trade this one because it went into the edge right there, and it went into this buy to sell that also caused a break of structure. And this is basically the big buy to sell that started the initiation lower. So where a lot of us can go wrong is being stuck in the middle in price action like this. And so then the problem comes is that you're not aware of where the hard time frame is and where the hard time frame levels are. Right? So that's my tip. Just stick to the hard time frames. And like you can just simplify it, as I'm going to give you my trading plan later. You have a 4 hourly OB or you have a 50-minute OB, you just wait for the market to tap inside, and then you jump on the 1 minute, and then you wait for your pattern. That's the simplest thing that you can do. And as simple as that. You do not need to trade all of those. You do not need to be short from here, then long from there, and then short from here, and all of that stuff. No. So let's jump on to some entry patterns. Yeah, just a little note on strong, weak and strong highs. So usually after a strong high or low, you will always see mitigations away from it. And it's usually formed with a V-shaped formation. So how a strong lower high form, you usually have, again, a very sharp V shape. You're going to have a push away, and then you're going to have mitigations away from it. And then what basically becomes a strong low is your sell to buy. And this one should be protected. And this is why you can be safe to enter an aggressive entry from 50% of this, because this is a strong low right there, so it shouldn't be broken. Okay, and it's always going to cause a break of structure. That's why we also call them confirmed highs and lows. And yeah, as I said, those are supposed to be protected. Okay, and usually that strong high, what exactly I showed you on EU, this strong high is going to be the edge of the price. So this is your best place to trade from, the edges. So basically, this is going to be an edge because this is a big sell to buy. So basically, this one is strong. Why is it strong? Because it broke structure. And if we're going to be continuing to trend higher, then basically this one right there is going to become weak. Because if we pull back right there, and if this big sell to buy holds, then our next target is the weak high, which is basically going to be this. Okay. A weak usually is going to form in a flat manner. So can we say that this is flat? Well, right now, this whole creation right there, this whole thing is flat. Like, look how the low formed right there in a very strong V shape. This is also V shape right there. And look how the high is forming, flat. Look at this flat high as well. And look at the low, how it formed. Look at this high right there, and look at the low that was down there. So basically, those are little things to pay attention to. And yeah, we trade from strong highs, and then we target the weak lows. It's basically trading from a higher low and then targeting the higher high, the previous higher high. Okay. And of course, all of these concepts can be applied on every time frame. The higher the time frame, the better. As I said, I mostly use those things on the 15-minute to the 4-hourly to identify the weak highs and weak lows. Okay. So yeah, I can jump on the chart for examples, but I have a lot of documented examples that I'm going to be doing videos on. So let's cover the theory right now, and then potentially we're gonna jump into more examples, and I'm going to show you what to do from now on as well. So let's jump onto some entry patterns right now. The majority of those are going to be familiar with you. This is basically our type 1 and type 2 entries. There is the type 2 entry. We have a higher time frame OB on the left. Okay, and then we basically have that same thing that I spoke to you develop. We have a range. The market will manipulate that range, tap into the higher time frame on the left, which is as well going to be maybe a range like that, just on the left. And then we break structure, of course, and it can develop in numerous ways. This is just one of the developments that could have. Maybe we can have a break of structure right here. The market is going to pull back right there to the main entry, and this is just going to be liquidity. And then right here, we're going to have another range, manipulation, initiation higher that broke structure. We're going to have another pullback and then just continue to go higher. So this is basically our type 2 entry. And copy this one onto your, just make it on your own and then just go on the charts to examine it. There is the same thing. Higher time frame OB on the left. That little line signifies, for example, a buy to sell on the left that I have spotted. Usually the market is going to come and mitigate that buy to sell by taking liquidity. So we have again the range, manipulation of the range, initiation lower, that breaks structure, liquidity is forming in between. We come inside, we mitigate, we break structure lower, and then we just continue following the flow. First entry, which is the main one, this is your aggressive. There is your second entry, and there is your third entry that you can play with this entry model. And I think you're aware of that. There is another variation. Like this is with the trending creation of the OB. So you have a downtrend, you have a big sell-off that mitigates an OB on the left, and then have a big expansion to the upside. Okay. So if you have this, then you have to monitor for liquidity. So basically you see they formed on the top, on the bottom as well. We push lower, a little range, manipulation into the OB. So this is where you can get 1 minute entries right there. And then we just initiate higher and break all of those structures to the upside. So this is another entry model that we see quite often. There is the short scenario as well. So make sure to copy those onto your training plans and make sure to, well, what I do is I just check them before each trading day. So I'm like, okay, cool. Just walk through them like this so that I know what I look at, and I really try to embed them in my mind. There is also another variation because it might get too much. So I would advise to stick to little ones, but those are the ones that I have found for myself after testing and forward testing a lot. Again, we have a downtrend. The market taps into higher time from OB. We have a break right here. We have a break right there. And then the market pulls back, creates a little consolidation, tries to push up, but fails. And this is when a lot of us can get confused because we have a failure to break structure right there, or maybe it breaks by a little bit, but then we just have sharp retracement down without that much liquidity. So again, we have to spot those on the charts. But this is another entry model, which you can see it's slightly different than this one, because this one has a lot of liquidity generation in between, while this one is just break structure, pulls back a little bit, pushes higher. So basically we have only this one, which is again, OB, previous low, and also imbalance. So you can also pair them with what the vet taught you yesterday. There is the short scenario. Again, I'm showing you those so you can have them as reference points. So you can draw them on your charts and then just go and examine them. Okay. And there is the Asian range play, which is basically what you're going to pair it with the projection blocks. We have Asian highs and lows. The market manipulates lower. Always see what is there on the left. Again, it's not just the projection block. Always see what is there on the left. It has to mitigate something. Then you're just going to have a break of structure, retest of the OB, and targeting the Asian highs. So this is your Asian range play that you can couple with, again, with timing, what the vet explained yesterday. Timing, OBs on the left, projection blocks, premium and discount. So this is your entry model. And you can, of course, just draw the entry model, and on the left right there, type all of your little rules. There is the short scenario. Okay. Some notes right there. I'm not going to read them too much. But yeah, those are basically the main models that we're going to utilize. And there are tons of different variations to them. And as I said, they're more like schematics. So just try to have them like this as schematics, and then try to identify them on the charts. And then just, for example, make a little album. I call it Trading Magazine, and just have all of those schematics with real-time examples. And yeah, so let's see right now, we're going to jump on to the next section, because when it comes to the entry, that is when it gets confusing, right? You can, of course, solely trade based on those patterns because they're mostly happening on the higher time frames, right? But if you wish to refine even further, get more confirmation and further reduce your stop loss, then you can go on the 1 minute time frame. Okay, but first, really important, is to start by understanding all of those things that we covered just right now. Okay, start identifying the ranges, the OBs, how does the sell to buy and buy to sell form within the OB, how do we initiate outside of the OB, how then we stop the initiation and launch the mitigation phase, then how the initiation becomes liquidity, and how is everything fueled. So first of all, this could be your first task to really learn those fundamentals, because right now, as we drop to the 1 minute, this is when, again, as Johnny asked, it could become a bit too complicated. And if you haven't mastered those things, you will get lost. Okay. And basically those patterns and setups, we see them, guys, every day. This is why we have the community, the data analysis, the webinars. If you just go back right now on the webinars and just rewatch them after this knowledge, you're going to see that all of those things that I spoke about, and they're going to make sense, maybe after the theory that we just had. So I hope everything is clear right now, guys. Probably your head is banging. I'm sorry about that. But right now we're going to jump to refine a little bit. So we're going to have a look at some entry patterns, and basically I'm going to tell you what I do right now. Okay, those are this is just an influx of information. This is all I have learned, all I have gathered. So again, as we discussed yesterday, you choose what to pick from those boot camps and what to put into your training plan. But right now, I'm going to show you what I do personally right now and what is in my training plan. Okay. So usually you're going to have 3 entries when you look for a trade. Okay. So there is the first one, the aggressive buy to sell or sell to buy entry. Guys, this is basically your RIM, the range, initiation, and mitigation. And you just trade it aggressively from the sell to buy. That's it. As simple as that. Okay. This represents type 1, which is basically, again, the breakout structure and the first retest. Okay. Usually on session openings, we can see a sharp tap into those zones and an immediate reaction. The stop loss could be a little bit bigger on those ones, because basically that sell to buy could be a bit big, and you want to place your stop loss below the protected low, right? Which is basically the low that then later broke structure. But of course, you can always get a conservative entries by using the flip and break, which is the next setup that we're going to have. And of course, a little detail, it's always best if you have some liquidity generated before the tap. The more liquidity, the better the setup will be. Okay. Because yeah, as I told you in one of the range creations, sometimes you're going to have a little pullback right here and then a push. So this is liquidity. On the initiation phase, you're going to have a lot of liquidity as well. Basically, the market is going to react from those, and all of those reactions later, all of those things are going to become liquidity to fuel the market, to fuel the move higher. But just before it taps, you always want to have a little checklist on the left if there is some liquidity taken. So in this case, do we have it? Yes, we have equal lows. Maybe we have it right here, and then you can feel free to enter from there. Okay. And as I said, liquidity here, this is basically, we have like little ranges that act as liquidity, and we just take them out on the way up, fueling again, because this is also some sort of a range. Then we have a manipulation and then initiation lower. So that is the first entry setup, guys, the aggressive buy to sell and sell to buy entry. And I do think I have examples right there. This one I do not trade a lot, and this is why I'm not going to focus too much on it, because I think it's slightly lower probability, but we have seen it play out. So basically what we can see right there, this is the 1 minute, guys. We can see a big hard time frame OB being created right there. So you have like a bigger range, a big buy, a sell off, but then we did not break structure. And then you can see again what somebody asked me. We can see the shift even on the 1 minute when this range is being accumulated. So what we have right there is a little range manipulation, which is basically the buy, then a sell off that broke structure. It also mitigated something on the left. And then you can see that we did not mitigate 50%. But we just started going away into the initiation phase, right? And basically what I said right there, that this whole price is a 1 HOV. So good that I left the note, but where did the move start? And this is where, guys, at the beginning, I taught you about buy to sells and sell to buys, because this is the move, the buy to sell, the last mitigation right there before we had the initiation lower. Okay. And what we have is liquidity exactly below the B2S. So basically, if we have a look later, the market went into a big initiation phase to the downside. Then we had the mitigation phase. And what we have just before the market taps it, we have highs right there, really flat price action. And again, guys, I keep repeating this. What do we have? We have a range, manipulation of the range, initiation lower. So right now we expect a downtrend, but it's the same pattern. Okay. And then basically what you can see is that, oops, there's the buy to sell, the market reacts spot on it, and then we reverse lower. And this type of entry is really well paired, I found, with the projection blocks, because usually if we have a projection block aligning like this with a high time from OB and with a refined buy to sell, you're going to have a spot on trade, as it's on this example right there. So this is our first entry model. There is our second entry model, which is a really good one. But the first we should cover the, okay, I've left the flip and break for the last one. But basically they happen in a different sequence. First you have the aggressive, then you have the flip and break, and then you have the continuation. But I have first tapped the continuation right here, because then the main one becomes the flip and break, which is what we want to focus on mostly. So this is the conservative type 2 approach. And when the market basically mitigates the high time from OB, taps into the sell to buy, then we just have the market entering into initiation phase. Okay. And this is when the market starts actually trending. It has stopped an area and is just starting to reverse from it. Okay. And you trade this until you're wrong. So basically you just keep trading it to the downside until the market reaches a hard time from OB, and then it just starts reversing, which is basically then a new phase starts. And then what we have, guys, is just basically, again, the same thing, sell to buys and buy to sells, or just one candle OB. It could be buy to sell, the market breaks structure lower. Whereas the buy to sell, it's this one. Usually it's going to have some liquidity, entry from right here, continuation lower, always liquidity generating, always spot for this, manipulation, initiation lower. There is the new one right there. So just keep doing this until you're wrong. And I'm going to show you some examples right now, but I do think all of you are actually pretty aware of this. So basically then there is potentially our aggressive, and then we just have with the continuation. So there is, for example, a good example right there. So I'm not sure what this one on the left is, possibly an aggressive, but there is the hard time frame mitigation. As you can see, we have an equilibrium level right there. So this is possibly a sell to buy on the left. So there is our initiation phase to the downside. The market taps into it, and then you can take it aggressive from here, or you can just wait for the market to change structure. So there was a little range, the market initiated lower, then we tapped inside, we failed to react from it. And well, what we do is we have a new range right there. We have a sell, buy, the market taps into it. There is our first trade. Then we have, again, guys, if we just zoom in, the same patterns. We have a range, little manipulation of the range, push higher. There is little liquidity right there, tap into it, continuation higher, break of structure. Then this basically becomes our next area for potential mitigation. So there is an example of 2 setups. So after the aggressive, you have 2 continuations to trade off from. There is another one, for example, the market mitigates an extreme level on the left. Then it actually breaks the last range. So we have a little range, manipulation, pushes lower, comes inside, but breaks it. And then this one is a little bit tricky because personally, I think right now looking at it, I would have maybe looked at this one, because it has liquidity right there and right there. But what I just told you before, guys, is this is where it's not a mistake. Maybe it's just a preference, but this is when then this becomes a big, there is your range creation with a trending market. So you have like a push, pullback, a big sell-off, and then a big buy. Okay. So it's not a range manipulation. It's not just a move down, up and down, but it's a downtrend, big sell-off, and then a push up. And usually this one is not going to get mitigated. The market is just going to keep moving away. So there is a good example of this. We just have a little candle, break, retest. There we have a sell, buy, flat highs, mitigation, push, a range, initiation, and then there is another long right there as well. So you just go with the flow and you just keep searching for either one candle OBs like this or ranges of sell to buys. Let's see if I have another example. There is potentially an aggressive trade right there. Again, we can see that we have a sell to buy on the left with the EQ2. You enter right there, and then we can see that maybe you can trade it from here, but this is where we broke this, which was a 5-minute lower high. And what do we have again, guys? We have a range. There is a manipulation of the range, initiation higher, first mitigation. What do we have within that mitigation? If you really look on the details, is we have a little range, manipulate lower, big buy that broke structure. Trade from here. Then we have a push higher, and then you can say, why don't I trade from here? Well, because the market created a new sell-off and then bought again, a new sell to buy. Also some liquidity, mitigation, continuation. Okay, so you see how we just keep following. There is actually then a new one, how it tapped inside, it was with the new sell to buy right there. So there's your another trade into the highs. So just keep following this until the market taps into something on the left, which on this case was 1H equilibrium, and then we start to reverse lower. So this is the continuation buy to sell, sell to buy. It's really nice. There is another one. This is a bit of an extreme example right there, because you can just see that you can follow the market as long as it lasts. There is something on the left right there, and this is 6R. This is EU. By the way, all the charts you see are EU, when EU used to move in a proper manner. We have a little range, a little manipulation, but then there is our last sell to buy, the broke structure, first trade right there. Then this one was just one candle, which is still fine. It's not a range, so it's just one candle, but it broke structure into the highs. It created liquidity there, liquidity there. There is the tap of that one candle. And then basically we again accumulate, and then we have that last sell that also took this little liquidity right there and initiated higher. So this is basically a flip. There is our trade. What we have is we pull away, we have a sell, a big buy that broke structure, another trade. What we have right there is an OB that broke structure again. There is another trade. Okay, so you can see that we just keep following the flow until we're wrong. This one is very tricky, but I put this just on purpose for you to see that it's not really easy, but if you just learn how to spot the rim thingy that I mentioned to you, a break of structure, the range, you just keep following those mitigations, and basically those are 3 trades. All of them are with 5R, and this one is 6. So this is 21R for just a single session right there. So this is why.
Can I just ask a quick question on this?
Yeah, of course, bro.
On that second position that was taken,
This one.
how come you would? No, sorry, the one just before it.
This one.
Yeah, the candle up. How come you wouldn't take the trade from the next candle up rather than the bottom one? Do you know what I mean?
So you want to take it from here after the engulfing candle?
No, I'm wondering why have you taken the following trade from that candle and not the one that's halfway up, if you get me?
Are you speaking about this entry?
No, sorry, I'm speaking about that push, but yeah, the entry is the following one, sorry.
This one. Ah, okay.
Yes. So
Yeah,
how
well,
come you've entered from that candle and not the smaller
yeah,
one that's
of course you can take the bullish candle as well. That's fine. Basically, this was the last sell candle before the big buy, which is usually like how the OB forms. So, but yeah, it also, I found out that this bearish candle was engulfed by the bullish one. So this is why I took the bearish one.
yeah,
But,
what I mean, where you've got that structure break one,
okay.
and then if you follow it down and you've got that last down candle before the push up on the other to the right, and then
Oh, this one.
no.
Can you draw on the screen, Kyle? Are you on your computer? Okay, where did Kyle go now?
Yeah, I don't know if I can do that. It doesn't matter anyway. No worries.
This one. Is this the one that you're asking about?
Yeah. That's
okay, okay. Thank you, Joseph.
You're welcome.
Yeah, thank you, man. I was getting confused.
Cheers,
okay,
bud.
yeah, well, I'm gonna tell you why this one didn't work out is because if you pair it also with premium and discount, this is in premium right here. And what you see is you can take a trade from there because it's still a range. It give you a reaction right there, but it just failed because it needed to drop lower to mitigate the lower one. Because that is where, as I told you, you have a range, a big sell-off, and that big sell-off ended up right there. So this is where they actually are at loss. So they would really love to go as much deeper as possible in order to mitigate their losses. So basically this one, again, as I told you before, avoid stupid losses like this and only trade from the edges. So if you have like something in the middle like this, avoid it. Set an order on the lower one. But yeah, that's a really good point right there. Because you can say that this is the OB that broke structure, which is correct. And this is why you get a reaction from it. But it was the origin that was important in this phase. And this was the last mitigation right here. And it's just like first mitigation, second mitigation. Then there is the third, fourth, fifth right there. Then you can ask me about this one. This one is also pretty good. So you can ask me, why didn't you take it from this candle, but you took it from this range? Well, because this range was right now nicely deep into discount. Right here, it's definitely before 50%. And it's also a nice kind of a sell to buy. And also, if you combine it with another thing, it reacted from this supply. So basically reacted from supply and then broke. So this is basically the flip and break, which we're going to have a look in a bit.
Okay, thank you.
Hope it makes sense. And this is what I was also speaking to Paul. I'm not sure if Paul is there. So he asked me, how can I draw the premium and discount ranges on the 1 minute? Well, just find, so if your move starts from here to there, 50% trade below it. Move from here to there, 50% trade below it, right? Move from here to there, 50%, and again, trade below it. It's all the same. It's just like lower time frames. Okay, cool. But yeah, those things are in Liro, and like the risk to reward is insane. Like I don't have risk to rewards right here, but yeah, this one is just 21R in this price action. There is another one, again, slightly tricky. So basically, yeah, this one is tricky right here, because you can ask me, okay, why this one, but not why the one below that? Well, basically because they're mitigated. We spot what is the last thing that is left unmitigated. So right here we have a range, a sell candle, it was mitigated. Right here we have this candle, it was already pulled back into. Then we have a range, then this is the slow candle, and then we start initiating higher. Liquidity is being built up, tap inside. If you miss this one, if you think that is going to go lower, it's fine. Cool, you miss it. There is another breaking structure. So then where you want to take the trade from is, like this was the range, there is the manipulation that we initiate higher. So basically I would either take it from the edge again, right there, or maybe take a sell to buy like this, which basically we did not tap with this candle. That's cool, because what we have is a new range, a big candle with a wick that took liquidity, broke structure higher. So this is our range initiation. We also have a little mitigation right there. See how we broke structure? We went to mitigate this little guy right there. And then we actually went to make the actual mitigation, and then we continue higher. Then again, we break structure. We have a buy, a sell that already pulled back, broke structure, another trade. Maybe another buy, you can take a trade from here. Then there is another range, push into the highs, really strong push into the highs. We have a strong push into the highs here. This one was not really clear. This one is not really clear, but the other twos are good. There is the range, strong initiation, liquidity. Again, a little mitigation phase right there, a failure to break higher. But this is just the 1 minute. It happens too fast. So you don't want to trade counter trend on the 1 minute like this, because it happens for minutes. A tap inside, continuation. There is right here, it reacted from supply, sell to buy, that broke structure. Can we take a trade from here? Yes, there's your other trade. So just keep following those, and you keep following the mitigations. And of course, this is for you to exercise. Like I've done this so many times, and for me, it's too hard to actually spot it live. Yes, John, I see you unmuted.
Yeah, sorry. Sometimes you're taking the trades at 50%, and sometimes it looks like you're taking a touch on the highs of the OBs.
Yeah, Johnny. So I take 50% only if it's a range, and like a sell to buy. So, and that should be like more than 1 or 2 candles. For example, this one right here was just 2 candles, but it didn't make sense to drop a big range. This one is just 1 candle. I would have dropped the range on this one, for example, like this, and then 50% is going to be here. Maybe even the 25 got tapped by this candle, but this is just 1 candle, so it doesn't make sense to drop a range. We're going to see later, like on this examples, it's only... So there is a range. So basically I can take only this candle right here. I can take only this candle right there. But for me, the whole thing is this sell to buy. So I take the ranges, there is 50% tapped. So again, you gotta see what makes sense. Sometimes it makes sense to just drop a zone on some occasions because it's just either 1 or 2 candles. But sometimes if it's a series of a couple of candles like this one, then you drop it as a range. Or you can, of course, take 1 candle. It really depends on your preferences. I hope we have more examples of that later. Okay, let's speak about the flip-flop setup. What's the time, man? It's already too late, and we have so many examples to cover, so I'm going to rush in a little bit. So this one, I want to spend some more, and I have tons of examples on this one, guys. So I hope we're going to merge everything that we learned so far in all the examples that are upcoming. So this is a very simple approach that is very logical. So it just indicates a shift from supply to demand market and vice versa. And again, it's important to follow all mitigations and then spot which is the last one that fails and causes the flip. Okay. So there are, of course, a lot of variables to this schematic, and it's what is important to just flow and just observe. And we're going to see a lot of examples of this. So basically, there are three main types that you can see, which are right here. So basically, we have the market moving down. This also could be a range. The market pushes lower, taps into a higher time frame OB. It's really important. It's going to be in the rules later as well. The market pulls back, respects the last supply, creates a sell, and then a buy. Okay. So in this case, what you could have is maybe an OB right there, but you're not going to take it from there because this is the OB, this is the sell to buy that failed the supply on the left. And this is one could get a little bit tricky. And this is why there are a couple of scenarios, right? Then there is this one, which is basically, again, as I said, it could be a range, manipulation of the range, initiation higher, but then within the initiation, you can have just this supply, which is a no follow through, create a nice sell-off. Preferably the sell-off could maybe even pull back into 50% of this leg. But those are minor details that you're going to be spotting when you trade. And then we initiate higher. Okay. And then there is the very often mistake that we do. We take the extreme on this occasion. While this is the thing where the orders were launched. This is basically you spotting the last sell to buy and where the orders are launched. And then this is the case, which is really important, where you're going to have the extreme. Basically, you have the supply right there, but the market just breaks through. And there is your rim sell. There is your consolidation, manipulation, very sharp move, and a big buy right there that broke structure, but it did not react right here. So it did not create this little pullback that we have right there. Okay. So in this phase, you either take, it depends on how the range, how the sell to buy looks like. It's usually going to have a one candle right there and then a sell and a buy. So you take the range from here and you trade it from the 50%. And in between this, you can, of course, have that pullback. The market is going to tap inside, then it's going to break again. So you take a trade like this as well. So I think you've seen this a lot, especially in the most recent webinars. So I hope that you're very familiar with that setup. So let's actually have a look at some examples. Okay. So again, we have a hard time frame range. The market is moving up and you can see how it's starting to cook. So there is the range being created. We do not have a clear manipulation above, but basically there is the range and the manipulation above. And then we start cooking within the range. There is our last buy and then a sell-off. So basically again, spot where is the range, where is the buy to sell within the range, and where is the initiation. So you can see that within the flip and break setup, you have all of those things that I spoke earlier. The range, initiation lower, and there is the mitigation phase when you basically have the reversal and it starts to build up liquidity. And there is flat highs. What you have again is another range, manipulation into the previous buy to sell, and then you basically had the sell-off later. Okay, so you can see how you merge all of those concepts that I spoke about in this one simple 1 minute trade right there. So this one is a really good example. Higher time from OB, consolidation, there is the buy to sell that broke structure, liquidity is being built up. We create another range right there, range, manipulation into the highs. This is basically where we enter, and then we just go lower. And then, of course, I can see right here that the continuations were not that clear because we have another range, like we manipulated higher, we break down lower, but then all those wicks actually went to tap inside. So basically, if you take this as a buy to sell, it was kind of mitigated by those two wicks, right? And this is why we just saw the market sharply impulse into the lows. Okay, so this is our first example, and I have a lot of examples on this one. So let's maybe rush them up a little bit. So I have some notes above Asian high into, yeah, so basically this one is tapping above the Asian high on the left into 50-minute OB plus a sell to buy on the left, liquidity grab, there is the consolidation, manipulation into the highs. And then you can see this one is a little bit tricky because we leave a little bits of liquidity. We break structure right there, we break structure right there. So basically this is our initiation phase. Then we reverse a little bit, and then we went all the way into the extreme. And when do we go into the extreme, guys? Do you remember? This is when we do not have a reaction from those supply area demand. So basically, yeah, well, we had a little reaction right there. So you can say that this could have been our buy to sell. Well, you can take the trade from here, but just keep your stop loss above. But what I spotted on this trade is that basically we had a buy, sell, mitigated right there. Then we launched order. So for me, this one was right here, liquidity. So basically that wick had to be mitigated. So those are little details. What we have right here, guys, on the left, have a look. Range, manipulation, initiation higher, fails to mitigate 50%. So basically this one is one of the types of ranges we have with low liquidity. This is our target. But look what happens. So it's really interesting because we mitigate a really hard time frame OB on the left. The market taps inside, tries to reverse, tries to push up, fails. Then we just break structure lower. So at that moment, yes, you can start looking for longs, but if you just follow the hard time frame narrative, this becomes just a reaction point. Okay, so possibly we had a range on the left, initiation, the market mitigated it. So this is our mitigation. And right now we're headed lower towards the weak lows. So this is why this long did not work out. And this is why it's important to also pay attention to the lower timeframes, to the higher timeframes, sorry. And where we went, if this was the weak low, maybe if this was the end of the initiation phase, we took it out. And then we reversed. Okay, so this is also how weak highs and lows work. So that one is a good example. And then what you have is a range, initiation low, and you can take a trade from here into that weak low. That is not a really nice textbook example. There is another one. So basically there is a hard time from OB. There is the last buy to sell, pullback. We have a range, manipulation into the range, break. The market reacts from the last supply, creates this little slowdown of price, and then initiates higher. So for me, this is the range that I want to trade from. And then again, we have a break on the 5 minute, which is really important. We have accumulation on top, which is basically flat highs. We return, and I trade it from here. So the stop loss on this occasion was 2 pips. So this stop loss is 2 pips, although it looks good. It looks very big. It's 2 pips. So I'm not going to go below 2 on any occasion. And I embraced the low on this one. So I wasn't stopped out, but it was nice to see that on some occasions we have a retest of the extreme as well. So it wasn't this one, but it went into the extreme right here. But this is a good example of one of the flip and break setups where we actually get a reaction and then we initiate higher. And as you can see, 2 pip stop loss, and we just rocket it. And there are actually a combination, I think, of, yeah, it's not really a combination, but there is a loss. So this is an aggressive, I see that it's an aggressive buy to sell potentially. It gave us a reaction, but failed. Then it dives even deeper. Then basically there is our last supply. It comes inside, tries to react, fails, then pulls back, and then we break structure. So this one is a tricky example, but this is when we actually flipped. And this is the area, this is the sell to buy that broke the structure higher. So there is our first trade. Then what we have is a push higher. We have a big range, sell, buy. Then basically this becomes our range, initiation. There is all that stuff that happens. The market perfectly comes inside to mitigate right there. And what we have in between as well, you can see is that we have this high right here that broke structure lower. We pulled back. Yeah, it's really complex, this example right there, but this is a high probability long because again, we come from a hard time from OB. And after this high failed, we basically broke above it. We find where is our buy to sell or sell to buy. It's this one, sell to buy, and we take a trade from the middle. And then the market pushes higher, comes back again, which is fine. Why? Because we have our protected low. Remember, this is a V-shaped low that is not supposed to be broken because we also broke structure higher. And then, of course, we have the market pushing higher, breaking structure. It creates another sell to buy. So at this point, it doesn't really make sense to wait for this extreme down there because we have a new one. And then you can see we respect 25% and we keep going up until we basically flip at the top. So that trade was 12.4. This one was 6.2R. Not the best examples, but yeah, this is EU. Right here, what do we have is a big range again. Range, we very sharply manipulate into the range again. So this is the creation of a hard time from OB right now, all of this delivery. It's a 1 hour plus 5 minute refines. And what we have right there is a little candle right here. Then we have a buy and then we start selling off. So it's not really clear, but where is the last reaction from the demand? It's this buy candle right there. Then we break lower. We already look like mitigated, but not fully, because if I drop the 50% right there, maybe the 50% of this whole range, this whole buy to sell, there is 50%. So the 50% was not mitigated in this case at all. So you can see that it does not always work perfectly. And then what I was spotting on this example was that we had a buy to sell. The buy to sell basically reacted right here, but then it failed to follow through and we just went to manipulate higher. But if you trust this setup, maybe you took it from here, but your stop loss was a little bit above, you're good to go. And then we just have another rim right there. We have a range, we have a big buy right there, sell, the buy to sell that broke structure and basically launched the initiation phase. And right here, I've marked this as a flip. So possibly this is a higher time frame break. And then there is our last buy to sell, liquidity as well. Very sharp pull into it. And then I really want to zoom in on this, but I can't do it on Canva. We have, again, another buy, sell that broke structure, entry, range, buy, sell that broke structure, entry, push, pullback, entry. So as you can see, there are a lot of entries right there, but it looked a little bit too complex. I don't really even remember when I was taking those trades. It looks so complex to me even right now, because I haven't seen this delivery in quite a while on EU. But this is basically how you do it. So a hard time for mitigation, then you see the flip. So basically the last demand that was right there, fail. And also if you want to be as conservative as possible, basically this right here, this right there was a hard time frame demand or something, and it failed. It got a close below. So basically after this, you have the flip and a break on a hard time frame. But then what you have to do is you just have to find where is your last buy to sell, which is right there, mitigate it, and then just go. So cover those examples later as well, study them. I don't have the dates, unfortunately, on the examples. There is a very clear one as well. Like we have a range, it manipulated the range, it tapped into a demand on the left. There is the last kind of supply, then we broke structure. NFT is no follow through, natural. So no follow through is basically when the market fails to hold. So basically, if we have a tap inside and we break the structure, then this is a no follow through. And follow through will be if we tap and reverse higher. So this means that this demand holds and we're bullish. So that is NFT, no follow through. And there is an example when we actually did not react that much from the supply right there. We just broke it and we just pulled back right there. So this is our first entry. Then we broke structure. Then again, what is the level that really broke the structure? Well, for me, again, it was this little range. We initiate higher, pull back, initiate higher again. So this was liquidity for me. All of that generation, aggressive tap inside. And what we have again, supply or range manipulation. Then we broke the supply right there. And we can even take a trade from here, right there. Then what we have is, again, another range, a big sell-off, a buy that also broke structure. Again, you can see that I take the 25% right here. I can take the whole candle, but I take as a ranges right there so that I'm consistent. Taps into 25%, keeps reacting. And right here, again, there is the extreme because it doesn't make too much sense to draw a big range. So I take the extreme, it broke structure, pulls back. This is probably a 2 pip stop loss again, because I don't trade below 2. And then it was actually a break even because we reached the hard time frame POI and we're about to reverse. A flip and a structure break. Well, a flip, the flip is your first failure of supply or demand. A break is just a break of structure. For example, this one is a break of structure. This one is your flip because on the 1 minute, this was your last supply right there. So for example, a break of, how to explain it? So this is a flip right there because this was supply right there. And then it just broke supply. A break of structure is this, but we can classify also this as a flip because this was the supply that just failed to hold. And of course, a break of structure will be just a high that is broken. So there is a high. Yeah.
Can we maybe say that the flip is break of minor structure and the structure break is more major structure break?
Yeah, it's not. Wait, literally, it's not really the case. But yes, you can either say that it's a break of minor structure, like the first change from supply to demand, and then you have the major break of structure. So look at this one. This one was little supply right there, isn't it? And it got broken. So is this a break of structure? Well, not really, because the real structure, the real high is up there. But we spot the flip, which is basically just the market flipping from demand to supply or vice versa, and then just starting to target the break. So a break is just a simple break of structure. In an uptrend, this is a break of structure. But when we speak about flips, this is when the market is in the downtrend. For example, we start failing and then we flip. So there is your flip. And usually it's with a market structure shift formation like that. And then if you want to be even more conservative, like you can wait for a break like that and then potentially a retracement lower. But it's going to make more sense. But when you see it on the charts every day, also Divino is is sharing a lot of those things. Basically, he is trading from the very first flip. That's why he gets aggressive entries, because the market reaches somewhere and then he just sees that first break of structure, the first flip, the first failure of demand or supply, and then he just goes with it. There is another one. So for example, where is our structure right now? Well, I'm just following the little details right there. So there is that big wick, that is supply, pushes lower, then this is also supply. Why is it supply? Because it broke structure lower right there. But this was just a range. There is the mitigation down there and the manipulation, and then we very sharply impulse into the highs. So again, don't, Simon, you can just type them all as breaks, flips. It doesn't matter. I've marked it as a flip because for me, a flip is again the first failure of supply or demand. And a break is just if the market is in an uptrend, and if we just break structure, then this is not a flip for me. This is just a break and a new higher high. So that's the difference. But right here, so what we have is slightly tricky because this is a wick POI. This is a trade that I took as well. It was really hard to identify the range right there. So I saw that there was a sell to buy within that wick. And this is slightly a bit more advanced. But again, we have the liquidity generated against us, and then we have a push up. Have a look at this, for example. This is a buy to sell, right? So then it actually failed. It got broken with a wick. So you can also take it from here. So this is a trade that Divino would take, for example. But then we create this POI and we initiate higher. The market returns later. And if you don't wish to take it aggressively, so basically this one was an OB. Again, we have a range. Then there is our initiation. Then we start pulling back. And what we have again, guys, the same pattern. The range, manipulation into the range, that demand never broke. And what you have, that last little supply right there, which is this range, got broken. And then basically we went into the extreme to mitigate, and then we jump off again. So this is why I don't advise too much the 1 minute, because you can see how subtle and how precise it should be. There is another one, again, OB on the left, 5 minute OB. It mitigated a 5 minute OB. How did it mitigate it? Well, we had a little sell buy right there, and then it started changing structure. But basically for me, this one was an OB right there that broke structure. Or you can say that the whole range, the whole buy to sell right there. So what you want to do is you just take it from the 50%. And as long as the market remains in that 50% and not break above it, then you're good to short. Okay. But what we did right there is we again flipped. So this is our last demand, that sell to buy. We flipped it, pullback, first entry. Then we started failing to break a little bit. So we went for another further mitigation right there, which is not really nice to see. And then basically you can see that this one turned into demand. Demand tapped inside, but this naturally is a no follow through. So after this demand, if we do not make a higher high and broke lower, so this for me is no follow through. So what does that create is a new range. So this buy to sell that initiated lower, then all of this becomes liquidity. And where do we go? We go into that range right there. And this is a trade that I took, but I was slightly skeptical to trade it from right here, simply because this structure was not broken right there, but it later became a weak low because again, possibly this was a push lower, a pullback, and then we should be making a lower low. But this is the delivery on the 1 minute, and you can see how noisy it is. So what I spotted right here is again, like the market was creating an uptrend. There is the buy, there is the sell, there is the reaction from the supply, from the demand, sorry. Then we broke structure lower, and I just took it from here, ensuring that the stop loss went above. Because we mitigated 50%, so it should not go above. And then we continue to trade lower. So again, I'm gonna rush through those examples. Feel free to examine them later and spot all the little details. This one is a really good one. Break of the Asian low, tap into high time frame OB. Again, you spot where is your last supply? Well, for me, it's either this one, this little supply right there. It reacted, but failed to break lower. Then we have a break of structure higher, pulls back, mitigates, but I'm not into an entry yet. And then again, this for me was a structure break. Okay, it's not a flip anymore. It's a structure break. So we broke structure. And again, then basically this becomes our big sell to buy right there. Initiated higher, liquidity, there is the tap. But if you don't want to take it aggressively, what you just do is you just follow how the market forms. You have a push, a pullback, and a lower low. So what did create the lower low? It's this little supply right there. So we responded from it, and then we broke it. Okay, and after this one is broken, you just look for an entry. Okay, and you just take your trade from right there, which on this case, you can either drop the range of the sell to buy, or you can just take the extreme right there. On this occasion, I don't even see what I did right there. Those are just trades that I've taken and journaled. And then, of course, what we have is the market again creates another range, initiates higher. You can see that on the initiation, we have little pullbacks, but not really a lot of opportunities to engage in. Then we can take some shorts, but eventually the market comes inside. And this would be like a 5-minute or 3-minute OB, taps inside and reverses. Do we have a flip and a break right there? Not really, because you can see basically this low, this whole push lower was created by this supply. So we do not have anything as we had right there, like a little push, pullback, and a new low. We just had the push from here. So for me, this was the supply. And since that supply failed, I do think I would have taken a trade from here, but possibly didn't tap and continued to go higher. So that would have been a miss. But that is a good example right there, how you can combine everything. So you can take it from here, or you can even wait for a subtle flip. I call them subtle flips because sometimes if you are doubting on a setup, you can just wait for a very little one, a very little flip, which is usually always going to happen. And usually, so this was initiation phase right there. And the mitigation phase is going to start when the first supply or demand fails. This low that broke structure was made by this supply. We tap into supply, we react a little bit, and then we break it. So we know right now that this from here, it's the mitigation phase into a higher time frame OB right there. Again, guys, every time, what do? Range, manipulates above the range, flips, okay? And this right here, you can see, do we have a reaction from the demand? No, it just broke down. So what I know at that time is that it's gonna come to retest the extreme. So what I did right there is I just took this range. But what you can also do is you just take this whole buy to sell. And basically your 50% is gonna be right here as well. But I tried to refine it up a little bit. And I was also aware of this whole range, and you can see why my entry is a little bit lower right here. So it's possibly 50% of this buy to sell. Stop loss should be above, because if this is your buy to sell, then it should be strong. And although it consolidated, I've written trust. Maybe I bailed out on this trade and I was angry. This is because I see the angriness of this trust right there. So possibly I bailed out on that trade. And then you can see we just target the low, 6.5 bar. So that is a good example of a flip and break that did not react from here. So if it happened like this, let's say react from here, create a buy and then a sell, then I will take it from here. But we did not have this. It was just a break. So we go for the extreme. I hope makes sense. There is a good one. This is I think a favorite trade of mine because it took a lot of time, but then it just flushed aggressively really nicely. So it's again all about zooming into the details right there. This was a very strong demand right there because we had a range, we initiated higher, but we are in a 4-hourly OB. I see the red right there. This is a 4-hourly OB. So we look for shorts right there. So we do not really look into the longs. We just try to see the shift. What happens is we have a little bit of a flat highs right there. We have a range, manipulation above. So what is the demand that broke the structure up? Well, it's this bullish candle. This bullish candle got broken. So what we can do after this one, we can take the extreme immediately. So this is a divinal trade, very aggressive. But I didn't enter from here. And what I did is I just waited for a break of structure. So this right now is no longer a flip. It's just a break because the demand was right here that broke to the upside. Then we just flipped and then we just go lower. Then there is our range, initiation phase, liquidity, and tap inside. Stop loss is above. And yes, then we just roll to the downside. And you can see how we also responded from here, from that little demand, but it was just a response to pull back and then to potentially continue lower. Okay, so that one was a very subtle, but very powerful because you get very tight stop losses on this one.
Ilya, just a quick question on this one.
Yeah.
That's a 4-hour OB that the price entered, right? Do you have a rule to say that price has to go like 50% within that OB? Because you can see that there was I'm not sure if that works. There was a setup here, right, where you had the a flip, and you could have entered here and been stopped out. So do you have a rule for that, or?
Exactly. No. Maybe this trade is tradable because I see it's actually like a nice range. Then we initiate higher, then we break lower. So that could have been a trade, John. Yeah. Maybe there was something else. I see, like for example, maybe you have like the 1 minute sell buy to sell is probably somewhere right here, let's say. So then you can say that this is the first push into the zone, and usually you do not want to trust the first push too much. And of course, it depends on timing. I can see this is 9:30, so this is London. So it definitely looks good. But yeah, so this could definitely be a setup. Yeah. So I do not have rule. If it taps into 4-hourly OB, I just look for it. Of course, yeah, it needs to have a liquidity graph, which is the little trading plan I'm going to share with you. This one looks like a liquidity graph. It broke. So I do think this should have been a valid setup. Maybe you lose it, but then you just continue flowing. And if you're in a 4-hourly OB, you continue looking for sells. So yeah, thanks for pointing that out. Maybe, of course, there could be something that could, and this will become with experience. Like sometimes you're just not gonna like something and you're just gonna, for example, skip it due to some factors that are based on intuition, for example. Price always reaches. Yeah, that is also correct. You can say that you're always gonna trade from 50% OBs. But what I would advise you to do, guys, is if you again find the 4-hourly OB, go there on the 5 or on the 3 or on the 1 minute and find the buy to sell, because this is where the market is going to go. So if there is no buy to sell at the edge, for example, right there, and the buy to sell was a little bit higher, then this is how you get a higher probability trade as well. There is another one. It's a very good example. And this is a trade I took, I remember, very recently. It was one of my biggest bangers after the EU got really choppy. Again, this looks like the Asian low. Maybe we have a range, we have a big sell-off. Then we pull back. And this one, I risked half of this one simply because I did not see a clear reaction from this level and then a break higher. But you can see that it wasn't just a straight break above everything. We had a little slowdown and then we broke. And then I was seeing all of that liquidity right there generated. So I took a trade from here, but I also had an order right there because I really saw that this is where we basically had a little buy, a sell, and then a just big boom to the upside. So if you have a case like this, then you can play both of them. Okay, but because this one, I took it from here, but I was also ready to take it from there. What I also want to bring to your attention, guys, basically the flip is like a little game. You just play a little game. You just follow every single candle. This is a bullish candle. This is a lower high, lower low. Then this taps inside, creates a lower high, then breaks structure lower. So for me, then this one becomes the lower high right here. What happens is that the market pulls back, reacts from supply, tries to fail lower, and then it will break higher. So for me, this push higher breaks this lower high. And for me, then this one becomes a new area. So you can take a long from right here. If you doubt it on this one, then you can again wait for a subtle flip and break, which is what I call them. And you have it right there as well. Basically lower low, lower high. It failed to break lower and it initiated higher. So there is your trade right there. And then of course you can continue follow mitigations right there everywhere. So that was a good example. I remember, okay, a lot of examples, guys. I'm just going to go through them. Hope you're not getting bored at that time because it's been quite a while and it's not a lot of information, but it's just a lot of examples because I really want you to see this play out like this and to point out as much little details as possible. So then you can go out and just refine them. I can see right here that there was a 12 and 10 hour trade into the 50-minute OB, possibly. So that is really good. And what we have, same delivery, guys. If you see the market ranging, it's very good. What we have. So this whole thing right now, guys, is going to be a 4-hourly OB later, because you can see like we have a big consolidation, a really big sell-off, but then we basically, and as you can see, hard time frame manipulation, right? And basically what we have is the market creates a low, pulls back, then fails to make a new lower low, then pushes higher, then pulls back, and it starts respecting some bullish order flow. And then what we have is again a range and initiation higher. So I think why I took this trade is because we didn't really go to react from the extremes right there. We just stopped in the middle and I was seeing those flat highs. So I think, okay, let's try this trade out if we're going to head higher. And basically, if I just delete, what we have right there is the same thing. We have the initiation. There is some little liquidity. We actually tapped inside and then we reversed. So right here, where is the last supply? I'm going to ask you, well, we have a push, pullback, lower high, lower low, and then just a big break. Do we have a clear flip right here? No, because the market just skyrocketed. So we do not have like a push, a pullback, and then a reversal. No, we just skyrocketed. So basically what we do is we just take the sell to buy. And then there is our sell to buy, initiation phase. There is our mitigation. So the market shifts, you can take a short right there into this area, and there is your long. And all of that is based on a 15-minute OB on the left. And then you can see you have this trade, and then you have that trade. Just following the flow and seeing how the market is starting to shift higher. And okay, so this one is pretty clear. Right, okay, so those are all the examples, guys. To be honest, if we have time, because you can see I have so much prepared for you, but I think like all of that stuff, I have journaled and I've kept it also for this bootcamp. But I think it's gonna be a lot of stuff for today because we're already 2 hours in. So I'm gonna finish the bootcamp, and then maybe possibly I'm gonna record like a mini series on this one, because it's a lot of stuff that I want to mention to you. And yeah, I'm gonna put this as mini lessons. I'm not gonna go into it because I think already the examples were too much, but I have a lot more. So if you feel confused at that point, I have all of this prepared for you. Wow, look at this madness. And hopefully I'm going to record this in separate mini lessons. Okay, so yeah, I think I'm going to do that because I'm not going to cover all of those examples right now. Let me delete that. So guys, we're coming at the end. Don't worry. There is your checklist. Where did it go? Checklist for the flip and break setup. Those are the rules that I follow. First of all, I need a liquidity grab, which is basically a creation of a buy to sell or sell to buy. And again, we always see that when the market taps into a higher time frame OB on the left, it's going to have a big buy or a big sell. Okay. And usually it should have like some sort of liquidity on the left, right? Equal highs, alt highs, structural liquidity. This is when you combine the VET's teachings as well. It must mitigate something on the left, right? As it grabs liquidity, it should mitigate something. So you do not trade the flip and break in the middle, right? You trade it from a high time frame OB. I would even remove the 5 right there. 15, 1 hour, 4 hour. Higher time frame OBs. The 5-1 is already refining like the higher time frame OBs. So stick to 15, 1 hourly, 4 hourly. What you want to see is a sharp recovery from that area. You don't want to see the market. Okay, maybe I should just draw because I don't want to lose again too much time. You don't want to see the market like tap inside and then just like round about, because if it starts doing this, it's going to have another run lower. What you want to see is as it taps, maybe accumulates, as it taps, a sharp recovery. So this is important to note in your trading plan as well. You need to see the aggression away from that level. Then what you start doing is the flip. So you basically, as the market is moving down, as it makes this the liquidity grab, as it pulls back, giving you the V-shaped recovery, this is when you start looking for the flip, because you have to look at your last supply, for example, and then, for example, you're either just going to have a straight blow through the supply, or you're going to have a little pullback and then a blow through. Okay, and then basically those will become your 2 areas for an entry, and the flop, which is basically the break. So if you prefer not to enter in this aggressive one, because you're going to see this first on the 1 minute, but then let's say that you have like a lower high on the 5 minute, you're going to see the flip and break right there. And then the market is going to break the 5 minute structure. So this is be your flop. And then usually you're going to have later a time, a pullback and a continuation higher. So if you prefer to have a break of swing structure on the left or a new structure being created, what you can also do is, if you are afraid, for example, maybe you have that push, pullback, reaction, push. Maybe if you don't want to take it from here, what you do is you wait for a new confirmed high. So you wait for a new break of structure, and then what you do, guys, you just follow the continuation buy to sell, sell to buy. Okay. You can trade with the flip only if it's clear. So basically, if the flip is clear, if the area is clear, if you clearly see the interaction right there, and if you clearly see a clear sell to buy to take a trade from, take the flip. But if it's not clear, wait for another break, you're going to get another entry. So don't rush. And execute. So if you tick all of those things right there, just hit the button and execute, because with the 1 minute, guys, you're going to see all those candles print. Sometimes you're just going to have the, I've had on a lot of examples. Yeah, I don't want to search for it right now, but sometimes I keep closing this thing right here. Sometimes what you're going to have is the push lower. You're going to have the pullback. The market is going to react. It's going to break. And then the next candle is going to be the retest. So after the market basically shows you the flip, the no follow through right there, break structure above, the next candle is already in your entry. So if you have the flip and if you have that, and if this area is looking clear, execute. And if you're doubting, wait for it to mitigate, wait for another break of structure, and then you pull back again, right? And of course, if you get a good reaction, as I said, just follow the money. Just use the continuation buy to sell, which we also had a look at, and I'm going to be posting more examples of this. There is your checklist. Make it your own, print it if you want to. This is what I use for my entries. Daily processes. Right now we're getting into the end, so I want to mention a couple of little details. If you remember this from your first bootcamp, the first TFDW bootcamps that we did back in the days, those are the trading windows in GMT time right here. So I hope, because with daylight savings, it might be a little bit different. You have the Asian range. This is when you start preparation time, right? Your London window is from Frankfurt open to lunchtime. You take a break right there. You don't want to trade right there because, yeah, sometimes there are good opportunities, but the majority of the times you're not going to have the RIM, the manipulation initiation at that time. It's just going to build up the range. New York is going to open. New York is going to create the buy to sell. And then basically that is when you can have another flip and break. So make sure to have your trading windows and trade during those two. Okay, be precise. You don't want to trade from 6 to 5. Okay. Pairs in time, just a little, again, recap right there. The best trades are right there. You want to stay to EU, GU, AU, and GJ. Those are the best pairs to trade. Start with one pair, master one pair during one session with one entry setup, and then expand. Okay, this is something that I've been doing a lot, and this is why you don't see me a lot on GU, because I really want to catch those trades on EU. But if EU is a bastard, then of course you have nothing to do. Okay, and of course a little bit of those details, which is basically a recap. Know where you want to trade. Have your trading window, and yeah, don't just try to trade all day, because this is not how trading should be. There is a little process, which I do. Morning routine, wake up a little bit early. Don't just wake up and sit on your charts. Go do something else like water, coffee, meditation, stretching, running, cold showers, whatever you like to do. Then start by checking the news. Of course, as the vet mentioned, be aware of what is ahead of the day. Then just do your top-down analysis. We just explained this in the vets series yesterday, or the bootcamp. 4 HOBs. Refine the 4 HOBs on the 1H if needed. Okay. The new OBs that are making a strong higher low. So basically those are OBs that break structure. So we would not expect for them to be broken. Okay. Then you refine on the 15-minute to the 5-minute Asian range. But I think I'm going to have more on that later because I share a trading plan. What is important to note, guys, it's a little exercise that I want you to do is drop to the 1-minute or the 3-minute and start observing the order flow before and during Asia. Because that is how you're going to find the first setup, which is the aggressive buy to sell or sell to buy. Find out what has been left unmitigated from yesterday. Okay. How was the order flow during Asia? What is being mitigated during Asia? Where is the liquidity being generated? Okay. Where the market can potentially go. Pair this with the Asian range, the break, the projections. Okay. Put all the confluences. Then what I do is just set alerts at your 15-minute zones and just wait. And this is how you're going to avoid all of those stupid trades. Okay. Once the market taps into your area, this is when you go on the 1-minute, and this is where you go with the flip and break. That's it. A little process for you. There is a, man, this is so bad, the quality, but this is basically my trading plan. 4H, 1H, 15-minute, weak highs, flip concepts right there. The flip concept can also be used on the 15-minute. And I use this if I want to counter trend trades. So yeah.
Could you go back to the previous picture so I can just take a picture of it?
No, I'm gonna post it, bro, so you can screenshot and do everything later. Yeah,
okay,
yeah.
Cool.
Don't worry. This is in my trading plan, so feel free to screenshot this one as well. I'm not gonna read through it right now. And there is a simplified version that I did very recently, much more simplified than the previous one. So make sure to also screenshot this one right here. It also includes like the last 20 trading days, spot where the weak highs and lows are. And then basically the 15-minute time frame is also pretty important. Okay, so make sure to do that. And I'm going to go more in details soon on that stuff. Some exercises that I want to cover with your guys. So this is after everything is done right now. It's time.
Please, can you go back to the previous ones?
This one.
No, the other one.
This one.
Yes.
Which
I
one?
want to quickly screenshot down.
Okay, you can take a screenshot now. But basically, the bootcamp is going to be posted in 1 hour. So you can just go there and rewatch it. Okay, hope you took a
All right,
screenshot.
thank you. I'm true.
Good. Okay, so let me basically, I want you to read this on your own time as well. Basically, I'll just give you those exercises right here. Reading the higher time frame price delivery on the 1 minute. Okay, so again, as I told you, for HOB, go on the 1 minute and read how it forms. How does it create the zones? How does it form everything? Okay. Each week, observe different things and concepts. So for example, starting from now, in the first week, you want to observe how the OBs are formed on the 1 minute and identify the buy to sells and sell to buys within those OBs. Spot the ranges, okay? Then in the week 2, you can observe liquidity. Spot the weak highs, the flat highs, the equal highs. How do they get manipulated? In week 2, you can observe the initiation phase. How can you trade the initiation? Then week 3, you can observe the mitigation phase. When does the market actually end the initiation? How does it work? How can you trade it? Okay, observe and mark everything. Put it in your agenda and document your findings. So for example, what I have for every single week, I have something that I want to achieve. So very recently, I haven't been following the hard time frame. So what I say this week, I will only trade with the 4-hourly trend. I put it in my agenda and this is what I do. And I observe it and I make sure to keep myself accountable for it. What I want you to do is a trading magazine. I have this and I might actually be showing you right now how I do it. It's basically at the end of each day, week, you open up a new chart, you backtest all tradable opportunities and make it perfect. Okay, make it perfect, make it exactly the way you want to enter, but still keep it realistic. You can't go right there and say, okay, I'm going to be entering right here with a 1 pip stop loss. No, keep it realistic while still make it perfect. And I'm going to show you how I do it. Then another thing that I say to all of you to do is a monthly observation challenge. So for 1 month, you just paper, live, or demo trade, whatever you like, and you journal absolutely every opportunity you see, or even better, execute on it. Okay. Then you do that for 30 days, and you combine this with the observation of different concepts. Okay. And you just see how you improve for 1 month. I did this for 3 months using the 1 minute, and the improvement was just insane. I started seeing all of those things and all of those little things that I told you. It took me quite some time. And I was actually just live trading with a very small account and paper trading. And of course, after you complete maybe a monthly observation challenge, maybe you observe different things, you take notes, you're aware of everything right now, you're ready to do a performance review. Maybe before you jump for any challenges or trading live, you put a plan together, you summarize all of your learnings from the observation challenge, and you start trading live for a month or 2 or 3. Okay. And this will show you, this will give you an indication of where you are right now in terms of your understanding and of course, psychology, because it could be easy to backtest, but when you actually go to do those things live and trading the 1 minute live, it's a completely different story. So this is the things that I want you to do from now on. And I'm also going to show you how I do it. Risk management. I think I'm going to reserve this for a separate lesson, because this is really important right now. So I'm not going to cover risk management right now and trade management. Should I cover those? Okay, I just decided, guys, I'm going to do those separately, because I think risk management right now is a big topic for everyone. And I have found some nice approaches if you want to trade the 1 minute like this. Okay. I have shared with a couple of people that really wanted to refine the trading plan.
Yeah.
Yes.
Hello. Yeah, I have a reserved question that I even want to ask you regarding that risk management.
Okay.
I've learned a lot of things from your risk management plans and other stuff. But with those people that have small accounts, I had something of recent called account flipping. So
Okay.
I actually want to ask you, maybe you can go into that briefly. What your thoughts about it and other stuff. For those that
my thoughts about flipping accounts, is that what you're asking?
Yes.
Well, personally, yeah, I'm immediately gonna say is that I don't like it. It's a good thing to do, but it's not sustainable trading. So if you're looking like to turn like, yeah, I don't know, 1,000 into 2,000 or 10,000, that's fine.
Those that have limited, like below 100 accounts.
Yeah, Akala, I'm gonna do a video on that as well. It's
Okay.
basically a scaling plan. So even if you start with 500, I'm gonna kind of teach you how to scale in that account. Maybe you can do like a monthly investments inside it. And the more profitable you become, the more you can scale your account, increase your risk. And this is how you grow. Because guys, you can start, I promise, you can start with $1,000, and just for 1 year or just after a few months, you can be way ahead. It takes time. It takes just dedication, because you have to detach from trading big accounts. And basically, this is the thing about challenges, is that they're like, I'm giving you a 100K account and you're going to make a lot of money. But again, you can see that this is not always the case as well. So for me, it's much better to really master risk management, trading your own capital, seeing your own returns, not having the pressure of anything else, just trading your thing. But yeah, I'm going to do a video on that as well, about the scaling plan. And I was also really inspired by Johnny G, because he's doing it the same. So he trades a live account and he's kind of having a scale plan. If he's profitable for 2 out of 3 months, then he increases the capital. Every single month you can deposit. Like, for example, you can, if you take a salary, let's say of 2,000, you can separate 200, at least 10% to put into your trading account. And this is how it's really going to compound. And this is with investing, and it's with trading as well. Because trading is a tool to make you money. Trading is not a tool to just deposit like a casino and make a big bank of profit, or maybe take a challenge with 100K, make 30K right now and just go into something else. So I'm going to speak more about this, and I'm not going to cover the risk plan right now. I'm going to do it ASAP, because it's a lot of details that go into it. Basically, if you want to take 6 trades per day, your risk has to drop. But if you still want to scale your account, if you, of course, reach a little buffer, then you can increase your risk balance while still keeping your risk tight. So I'm going to do this separately. And also trade management. You can have a look at the slides right now, but I'm going to do this separately with more examples as well. Because basically, yeah, if I just cover it very quickly, just for your understanding, there is your the last supply, there is your no follow through, there is your sell to buy. This is where we take a trade from. So what you can do is you can take a trade after, you can go break even after the structure break. But then what could happen is, I told you, there is your next mitigation area. So you're going to get stopped out. So you risk your entry being mitigated. Okay. The next thing you can do is, after mitigation away from your entry, so there is your entry, the market pulls away, comes back, mitigates your entry, and then as it starts to push up, you go break even. And then the third thing, which is the best, is to place your stop loss below or above confirmed lows. So there is your entry, there is your flip, there is your no follow through, there is your sell to buy. You enter from here, the market breaks structure. So where is your confirmed low? It's this low. Because if this low gets broken, then we're wrong, okay? But I will not even manage it aggressively on the first break. I will wait for the second one to mitigate the entry, then to break structure above. And then as it breaks structure, then I find, okay, where is my strong low? That shouldn't be broken. It's maybe this one, or maybe this one. And this is how you just keep going. And then if the market breaks structure, then you just keep going higher. So I think this is the best one to actually utilize. I'm going to jump into more details right there, because yeah, you can see that there is a lot that I have written right there. So I'm going to make it separately. And just a little note before we end it up, be yourself. It's really important to just be yourself and find out what works for you, what feels right for you. Build your own system, build your own plan, your own strategy, your own management rules, your own case studies, your own backtest, and of course, your own mindset. Because again, we are the most amazing team that is available in the trading space. But of course, every single one of us is different. So the trades that I take, maybe somebody else is not going to be able to take. The trades that the vet takes, somebody will consider to be, yeah, just hard or doesn't make sense at all, or something like this. So be yourself. Right now, after the boot camps, rewatch them a couple of times. A lot more content is going to drop, because we give you the tools, but it's yourself. For example, somebody might hate the 1 minute, and you might be losing the 1 minute. So you should not be looking at me or somebody else and try to force trading on the 1 minute, because you can just simply kill it by going on your chart and taking a 15-minute OB, something like this, setting your order right there like that, and just forgetting about it. You don't need to do all of that stuff with the flip breaks, with the 1 minute, with mitigations and all of that stuff. So if it doesn't work for you, then cool. Be yourself. Don't look at the others. And it's something that I want to be promoting more in the community, which is also what me and Walter and Divino spoke about. We want to be transparent. So we will be sharing much more losses from going forward, because the majority we see only wins, or either trades that are working out. So trades that are not shared before they were taken, but after they're taken, if they go at profit. So basically we should keep it as realistic as possible, maybe sharing the trades before they happen, and just see what actually real trading is, and to see how each and every one of us is different. And Haval, if he's there, yeah, we spoke very recently with Haval, and the guy just wants to trade 15-minute and drops maximum to the 5-minute, and he's like, should I master the 1-minute? Well, no. If you don't understand the 1-minute, and if it's in your trading plan to trade the 3-minute, that's fine. Just because we show you the 1-minute, that does not mean that you should drop to it. And of course, first of all, you have to develop the underlying knowledge, which is all that bootcamp was about. Okay. And again, yeah, this is basically all the stuff that I said. I forgot that I have a slide about it. As I said, we're the best community, but this training is personal. We have our own understanding, our own concepts, the entry patterns. But you have to make it your own. You do not compare yourself to other traders and their styles. You are being you. Okay. So if I use a 2-pip stop loss and you use a 15-pip stop loss, you feel, oh man, I feel so bad. That guy is just killing it with 2-pip stop loss. Well, I'm losing more probably than you. So be you and follow your plan, right? And as I said, again, you see a lot of wins, a lot of green trades, a lot of profits, especially on social media and everywhere, but you never know what is behind the scenes and what actually the trader is dealing with. So cut off the noise. Don't look at anyone. Look at yourself. Work on your craft. And this is, I found, how you're going to succeed. So focus on you. And of course, as I said, let's try to be transparent and as honest as possible, because we want to see what is realistic trading. Again, we do not want to make huge returns, because it doesn't work. Like if it worked to make, I've been thinking about it with the 10%, 20% months or days or stuff. If it was that easy, everybody would be working for a bank and making shit tons of money, right? It's not that easy. So this is why I got really inspired when I had a conversation very recently with John, because John, I'm sorry, John, I might be saying your personal stuff, but I just want to say it. He is targeting 1 hour per week. So just think of it. He targets 1 hour. This is 1 risk to reward per week. This is 4 hour. This is 4% per month. This is around 50% per year. So this is how you have to think of. You don't have to think, man, I have to jump on the charts today and make 20 hours. No. If you focus on 1 hour per week, you're good. And this is what I'm going to speak more about the scaling of accounts and just trading properly, not going for those huge things. Okay. So guys, any questions? If there are no any questions, let's go. I have written in the slides right there. What's the time? Is it? I think I can go for 1 more hour, but it's already been 2 hours and a half. Guys, what do you think? I see 23 members are there. Was it too complex? Was it a lot of stuff? Did I speak too much? Thank you so much. Really great stuff to learn. Very nice, Simon. Guys, you're too quiet. Can I hear something from you? Okay, very educational.
All was good, Elia. Very interesting.
Very good. So yeah, guys, take your time to rewatch, because I tried to put in as many examples as possible. This is why I took all the slides of the vet. I didn't know Canva has only 100 slides. Yeah, I tried to make it as comprehensive as possible. And of course, you're going to see that stuff every single day, every single webinar. And also we're going to be doing more mini series on that stuff. So don't worry, more examples are to follow. It's really important, guys, from now on is to pay attention on this slide right here. So start doing those exercises, take it seriously. And if you're not where you are right now, if you're not understanding, if you're not making profit, or if you just want to take a step back from all that urge to make money, and take a step back and go and refine your skills, go and work on all those things that I mentioned to you. The range initiation manipulation, understanding hard time frames, understanding the entries, back testing the entries. One little thing that I wanted to show you is how I do it as well. Let me just share the screen. share screen one. So what I have right here, guys, is a trades magazine. So I have it right there. I have all of those things right there. So what I have is a trades magazine. So I keep this from the 12th of 7th. What is 7th? July? Or yeah, I don't know. But what I have is I put hard time frame analysis. So basically it could be just 4 hourly, 15-minute or whatever. And then what I told you is I put the entries as I want to take them. And have a look how much stuff I have. It's a lot. So for example, there it is, like the manipulation, V-shape, flip, the flip basically reacted, broke structure above, retested, cool. Another break of structure, cool, there it is. And of course, before that, what I do is I have so for example, the 5th, 10th, Tuesday, hard time frame. There's my hard time frame, there is my range, there is 50%. I'm looking to take trades from here, from 4HOB. We have a break of structure up. Then I'm gonna look at the 15-minute as well, how the 15-minute is looking like. And then I'm gonna jump on the 1 minute, and I either take those trades or I mark them as I would have loved to take them. So for example, if I didn't take this trade, I would have taken it from here, and I'm realistic, and my stop loss would be below. Okay, and I do this every day or every week, and I have all of those, and they're getting a little bit too much, so I have to slow down a little bit. But basically, yeah, this is what I want you to do. This is the trade magazine thingy. Okay, and as you can see, there are sometimes losses, of course. So yeah, this is another thing that I want you to do, guys. Do we get access? Well, I can maybe share this magazine with you guys, but the thing is, it's not gonna be of any help, because if you just see me taking those trades, it's not nice. You have to do your own. And you do this by just, for example, maybe you look at the community members, how they trade, and then you just go on the charts every day and you just mark out. So basically, if I share screen one, and if I go right here, basically, this is why you always see on my charts, I have all of those things, right? They're the folders, and I explained on the last webinar how to do them. Because for example, on Tuesday, if I trigger Tuesday, there are the trades for Tuesday, right there, with hard time frame, with everything. And then what I do is I just journal them in Notion, and then I can delete them from TradingView. And those are, again, all the trades that I would have loved to take and that are valid for me. Okay, so yeah, I can give you access to mine, but it's not going to be of any help. I want you guys to make a trading magazine. And if you make it, if you have like 50 trades in it, you call me and we can review them together so that we can have even more examples to put into the course. Okay, I think, guys, it's time to wrap it up right now. It's been quite some time, and your head is banging and you're bored or sleepy. I hope not. But I'm going to be sharing the bootcamp after it renders, so it's going to be available to rewatch later today. Guys, I wish you an amazing Sunday. Make sure to relax a little bit as well, and I look forward to next week with the new knowledge that we just got.
Man. Leo, thank you very much, bro.
You're very welcome, Renaud. Thank you, bro.
Thank you.
Have a nice
Thank you,
weekend.
bro. Very good.
Thank you, guys. Okay,
Thanks,
cheers.
Ilya.
You're welcome. Very nice. Bye-bye, guys.
Bye-bye. Thank you.